Hi friends, so welcome to this video where we will be discussing the RTP for CA Final Paper 2 Strategic Financial Management, which was issued by ICAI for May 2022 CA Final examination. So let's start. Children, the first question is from the chapter of security valuation. This concept on which this question is based on is the concept of securities lending and borrowing mechanism, where a person who wants to short sell the share borrows the share from a person who is already owning the share, sells it in the market, then in 3 months or 4 months, whatever the period of borrowing is, he then purchases it back and then gives it back to the person from whom he had borrowed the share. Now in these 3 months or 4 months, if the share prices have fallen, then this person who had short sold the shares will be having a profit. If the shares would have gone up, then he will be suffering a loss. So on that concept, children, I'm not going into the details of that concept now. We'll be discussing this question which is based on that particular concept. Okay. So what they are saying, Mr. A is holding 1000 shares of face value rupees 100 each of ABC Limited. So there is this Mr. A who is already holding 1000 shares of rupees 100 each, correct? He wants to hold these shares for long term and has no intention to sell. So he is saying that I am going to be holding it for long term, there is no intention to sell, but I am ready to lend it if someone wants it for a period of few months and then give it back to me. So on 1st January 2020, this company XYZ Limited made short sales of this company's shares and approached Mr. A to lend his shares under the stock lending scheme with following terms. So basically XYZ Limited is now approaching Mr. A and asking Mr. A to give or basically lend these 1000 shares of rupees 100 each of this ABC Limited so that he can short sell it. Short sell means basically sell it in the market, and of course he will buy it back and then give it back to A. This company XYZ Limited, today they will sell the shares. Children, XYZ, what is XYZ doing? They are saying to Mr. A that you lend your shares, okay? You lend your shares, we will sell it off, okay? We will sell it off, and children, in few months we will buy it back, okay, and give it back to you. That is the whole arrangement. Now for Mr. A, it makes no difference because he is anyways going to be sitting on the shares for long. So for 3-4 months, if someone else has it, doesn't matter if in those 3-4 months at the end of that period, those shares are going to come back to Mr. A. XYZ on the other hand is expecting to sell it at a price today and then buy it back in few months at a price lower than the selling price to then get that difference profit. Okay. So children, of course, if the share goes on a bearish trend, then only XYZ will be able to earn, because he will be able to sell high today and then buy it back at a lower price later. But if the share goes on a bullish trend, then for this XYZ Limited, which is short selling the share, there will be a loss. Let's read ahead. Point number 1, shares are to be borrowed for 3 months. Okay, children, so therefore the borrowing period for which Mr. A is ready to lend the shares to XYZ is for a period of basically 3 months. Second, lending charges or fees of 1% to be paid every month on the closing price of the stock quoted in the stock exchange. So of course, when Mr. A is lending, he will require some kind of interest, right? That interest is referred to here as lending charges or lending fees, which are to be paid as 1% at the end of every month on whatever the closing price of the share will be at the end of that particular month. Like that, 3 such lending charges XYZ will have to pay to Mr. A because he has borrowed the share for a period of 3 months. Next, point number 3. Bank guarantee will be provided as collateral for the value as on 1/1/2020. So Mr. A is telling XYZ Limited that, hey XYZ Limited, I do not know you properly. I need some guarantee that now that you are taking these shares from me, you will return the shares back to me. What is the guarantee? So children, this XYZ Limited has to go and purchase a bank guarantee so that on the basis of that bank guarantee, Mr. A will be giving the share. So that bank guarantee, children, will of course be costing something to XYZ Limited. Other information, point number A. Cost of the bank guarantee is 8% per annum on the basis of whatever the value of the shares XYZ will be borrowing as on 1/1/2020. We'll look at numbers in some time. Correct? Basically, the point is there is 8% bank guarantee per annum that XYZ has to pay. Point number B. On 29/2/2020, ABC's share quoted in stock exchange on various dates are as follows. So children, they have given to you few dates here. Okay, this is of course today. Then children, after 1 month, after 2 months and after 3 months, two scenarios are given to you. One is the bullish and one is the bearish. Of course, the bearish scenario will be more profitable for XYZ Limited. Bullish will be a loss making proposition. You are required to find out earnings of Mr. A through the stock lending scheme in both the scenarios. So they are asking you, what will this Mr. A earn out of all this? Children, the only thing he will earn out of all this is the lending charges. Everybody clear? The only thing he will be earning out of all of this will be the lending charges, that is 1% per month. Everybody clear? That is 1% per month. So now under both circumstances, under both scenarios, we have to calculate what will be the lending charges that Mr. A will be earning, yes, at the end of every month. That is what they are asking you here. What is the earning of Mr. A through stock lending scheme under both scenarios? So now let us do the calculations and see. Children, first of all, let us talk about the bullish scenario. As far as bullish scenario is concerned, do you realize the first number that we will be looking at is the price of the share at the end of the first month, 1020. This 1020, children, do you realize is the share price at the end of every month, closing price of the stock, and on that 1% has to be paid by XYZ Limited to A. So this into 1%. Then at the end of second month, this into 1%. End of third month, this into 1% is what Mr. A will get per share. Correct? At the end of these 3 months, we'll total all of that and we'll multiply by total shares, that is 1000 shares. We'll get the total earnings for Mr. A. Everybody clear? We'll get total earnings for Mr. A under scenario 1. Under scenario 2, children, can I say 980 into 1% plus 960 into 1% plus 940 into 1%? The total multiplied by 1000 shares will give you the earnings to Mr. A under the second scenario, that is the bullish scenario. Everybody, did you understand till here? That is the bearish scenario. Children, here there is some typing error by ICAI. This will be bearish. Okay, this will be bearish because can you see the share price is going down here and here the share prices are going up. So that is bullish and scenario 2 is bearish. Children, can we start? I'll show you the solution here. Calculation of total earnings through stock lending schemes for Mr. A. Lending fees are 1% of month closing prices. Then there are scenarios given to you, scenario 1 and scenario 2. These are your 3 months. For scenario 1, 1020 into 1%, 1040 into 1% and 1050 into 1% will give you a total earnings per share of 31.1. You multiply by 1000 shares. Total earnings come to 31,100. For the bearish scenario, 980 into 1%, 960 into 1%, 940 into 1% totals to 28. Okay, 0.8 per share earnings multiplied by 1000. This will give you 28,800 as the total earnings for Mr. A from the stock lending proposition. Now, children, the second point they're asking, what are the total earnings of A in this period under both scenarios? Now, children, there is a slight error here according to me in the question framing because question 1 and question 2 appear similar. Yes, in the question there should have been one more data concerning dividends. Okay, in these 3 months, some dividends must have been announced by ABC Limited, which of course were supposed to be received by Mr. A. But since he has given the shares or basically lent the shares to XYZ, he will not directly get those dividends, but XYZ Limited will have to pay from their pocket those dividends to Mr. A. Now children, if those dividends data were also given to you, then do you realize that in your total earnings, those dividends would have also added? Everyone clear? See, these earnings are purely from the stock lending. Additionally, dividends also Mr. A would have received, and the total earnings would have gone above 31,100 and 28,800 under both scenarios respectively. So children, that's what they were asking you. In point number 1, earnings through stock lending, that we have done. Now they are saying total earnings, which means including the dividends. But since dividend data is not given, the question is slightly erroneous. And if you see the solution, children, if you see the solution, here children, till here everything is correct, 31,100 and 28,800. But then for point number 2, suddenly from somewhere they have got the dividend per share as rupees 25. There must have been some omission, right? Some line must have been missed out in the question framing, and I have read the question thoroughly. I tried searching for it, it is not available. So children, this 25 rupees dividend per share was given somewhere in the question. Okay, that plus children, plus this 31.1 and 28.8, correct? 31.1 and 28.8 we had already got. Add the dividend per share of 25, you will get 56.1 and 53.8, and then children, you multiply by 1000 shares, you get total earnings as 56,100 and 53,800. This is a mystery for all of us, since that question data is not available. I am proceeding ahead. Okay, then children, point number 3, they are asking now, what is the profit loss to XYZ, the person who is borrowing the shares by shorting the shares using stock lending schemes under both scenarios. Let me explain this to you, children, from XYZ's point of view. Now students, do you realize that if I talk about scenario 1, XYZ will be selling the share at 1000 and buying it back at 1050, correct? Selling today at 1000, buying it back at 1050. There is a 50 rupees per share straight away loss to XYZ. That is what I have written here. Calculation of profit loss to XYZ. Gain loss on the short selling. Can you see 50 rupees loss? But that same thing when you see in scenario 2, 1000 rupees is selling, correct? 1000 rupees is selling and 940 rupees he'll be buying it back, correct? 1000 rupees is selling at and 940 is buying back, and I say 60 rupees will be a gain per share in scenario 2. Apart from that, children, as we have already discussed, this 31.1 and 28.8, the lending fees, which will be an income to Mr. A, will of course be an outflow or a cost to XYZ Limited. Everyone clear? That will be subtracted. And then, as we had discussed, there was a bank guarantee also that XYZ had to purchase on the value on 1/1/2020. Now value on 1/1/2020, children, is rupees 1000 irrespective of scenarios. So 1000 rupees share he is borrowing into 8% bank guarantee fees, but for 3 months only. Everybody clear? For 3 months only. And children, that calculation I have done here, that will result in a 20 rupees per share bank guarantee fees that XYZ has to further pay another cost. So if you take the total, minus 50 minus 31.1 minus 20 is a total loss. Okay, a negative earning of 101.1 and 60 gain minus 28.8 lending fees minus bank guarantee 20. There is a 11.2 rupees gain per share for XYZ in the bearish scenario, multiplied by number of equity shares. Okay, multiplied by number of equity shares 1000, you will get the total loss and the total gain under both scenarios. And children, if you check ICAI solution, they are getting the same number. Everyone clear? So children, apart from this point 2 where there was a data error, I hope you have understood the entire question correctly. So with that, we complete the first question of your RTP, which was based on security valuation. We will now go to the second question, children, that is also based on security valuation. Now this question, students, is based on the concept of duration and volatility of a bond. I already have recorded a video okay, in my video library, which is based on a very similar question. Of course, the numbers are slightly different. Apart from that, everything is similar. I will pull out that video from my video library. I'll present it to you right here, right now. You can watch the same and then we'll go ahead. Okay. Now, just I want to inform you that if you want to study the entire SFM from me, then I have my entire videos already recorded for all chapters of SFM. You have to visit the website online.jkshahclasses.com, and there you can purchase my entire course of SFM. Whether you want full course or you want fast track, both are available. Also, if you simply want to purchase a single chapter, that option is also available. Okay, so now I will show you one of my videos. You can go through that video, and with that we will be able to understand this particular question. Please watch. So let's now do one question on duration. I request everyone to first pause the video and read the question carefully. Okay students, I hope you all read the question. Students, this question I picked up from the old PM. It's there in the May 16 RTP, old May 18 RTP, November 15 paper. It came for 5 marks. November 2005 it came for 8 marks. It's also there in the old study material. Quite a famous question. Okay, so let's start. I'm very sure you understood what to do. It's very simple. Following data is available for a bond: face value given, coupon rate given, years to maturity given, redemption value given, and YTM given. Everything is available. What are the current market price? Current market price means future cash inflows discounted YTM. The PV is the current market price. Duration, I'm very sure you know how to do it. Volatility, last video we saw. Okay, calculate the expected market price if we witness an increase in the required yield by 75 basis points. Students, 100 basis points means 1%, 75 basis points means 0.75%. Let's start. Very simple. This is, children, question number 29. Let's start. So let us calculate the current market price and the duration in one table only. Okay, so I'll write down point number 1. Calculation of current market price and duration. Okay, so what are the columns? Tell me. Year, cash inflow, discounting factor at the rate 17% YTM, present value, correct? And then the last column, tell me what will do. Year into present value, correct? So 1, 2, 3, 4, 5, 6. Why 6? Because the number of years are 6. Yes. So now tell me, students, what are the coupons you're going to receive every year? 1000 into 16%, that is 160 rupees, and redemption is again par, that is 1000. So 160 every year. So I'll write down now here 160, 160, 160, 160, 160 and 1160, correct? Let's take the discounting factor, students. 1 divided by 1.17 equal to 0.8547 equal to 0.7305 equal to 0.6243. Okay, 6244 I will take. Next is 0.5337. Next is 0.4561 and the last is 0.3898. Everybody following? Yes. So now let's calculate the present value. This will of course be your current market price. So on the calc, 160 divided by 1.17 equal to M plus, that is 136.75 equal to M plus 116.88 equal to M plus 99.89 equal to M plus 85.38 equal to M plus 72.98, and then 1160 divided by 1.17, 1, 2, 3, 4, 5, 6 M plus, that is 452.21. MRC comes to 964.11. So 964.11, students, therefore is the current market price of your bond. Yes, we get it as 964.11. Everybody following? Let's now go on and calculate duration. Students, duration, I'm very sure you know what to do now. Year into PV, 1 into 136.75 M plus. I'll write 136.75. 2 into 116.88 M plus, that is 233.76. Next is 3 into 99.89 M plus, that is 299.67. Next, students, is 4 into 85.38 M plus, that is 341.52. Next is 5 into 72.98 M plus, that is 364.9. The last is 6 into 452.21 M plus, that is 2713.26. MRC if we do, we get 4089.86. Therefore, the duration, students, will be 4089.86 divided by 964.11. If I divide this by 964.11, I get the duration as 4.24 years. Everybody following? So with this, students, we get the duration also as 4.24 years. They are now asking us volatility. I am very sure you know what to do with volatility. Tell me, what is the formula of volatility? Volatility is equal to duration divided by 1 plus YTM. My duration is 4.24 years. My YTM is 17%. So 4.24 divided by 1.17, if I do, I get 3.62%. What is 3.62%? For every 1% change in yield, my bond will fluctuate by 3.62%. In the question, they are saying calculate the expected market price if the YTM will increase by 0.75%. So students, if YTM increases by 0.75%, the bond's value will decrease by 3.62% is for every 1% change in yield. Now for 0.75% change in yield, let's do the calculations. 3.62 into 0.75, my bond will drop by 2.71% from its current value. Everybody following? So if the current value, students, is 964.11, we will write down expected market price of bond will be 964.11 current price minus 2.715%. So 964.11 minus 2.715%, the expected value of the bond is 937.93 rupees. Okay, 937.93. Why 937.93? Currently the value is 964.11. Students, my volatility considering my duration of 4.24 years is 3.62%. That means I know if my yield will change, the YTM changes by 1%, my bond price will fall by 3.62%. But if the YTM is going to increase only by 0.75%, so my bond will fall by 3.62 into 0.75, that is 2.715% from its current value of 964.11. Therefore, the expected market price is 937.93. Everybody following? Okay, students, so with this we finish this question number 29. I hope you understood this question. I will now flash the solution of this question on your screens. You can pause the video and copy down the solution. Thank you so much. Okay, students, I hope you all understood the entire question, and I also hope you understood that this question 2 of your RTP is a similar question. Okay, so now we will go ahead. We'll go to the third question, children, that is from the chapter of portfolio management. Let's begin. Students, they are saying Mr. A is having 1 lakh shares of K Limited and the beta of the company is 1.4. Mr. B, a financial advisor, has suggested to have the following portfolio. So children, this Mr. B is saying that instead of putting all money in one share, you spread out between L, M, N and O, having these individual betas with these weights, correct? Now children, do you understand that if Mr. A decides to go for this portfolio, then the beta of the portfolio will be simply weight of L into beta of L plus weight of M into beta of M plus weight of N into beta of N plus weight of O into beta of O, and that will give beta of the portfolio for this portfolio. Everyone clear? So here, if Mr. A decides to put entire money in K Limited, do you realize the beta will be 1.4? If he decides to put entire money in this portfolio, then children, if you can see, the beta of the portfolio will be, these 4 securities are there, they are betas, we multiply by their weights, we get the portfolio beta as 1.015 times. Everybody clear? 1.015 times. Now students, what they're asking you is that if RM is 12% and IRF is 8%, okay, RM 12%, IRF 8%, you are required to calculate the following for the present investment and suggested portfolio. So point number 1, they're asking you what is the KE based on CAPM. Children, we know the formula of KE is IRF plus RM minus IRF into beta. Now students, if we calculate KE for present investment, that is K Limited, IRF and RM will remain same, 8% plus 12% minus 8%, and the beta we will be taking is 1.4. So here for K Limited, the KE will be 8 plus 12 minus 8 into 1.4. And now they are also asking you to calculate the KE for the suggested portfolio. Now children, everything will remain same. It is just that instead of 1.4, we will take the beta of the portfolio. Everyone clear? Instead of taking beta of K, we will take beta of portfolio. Everything else same. You will get the KE for the portfolio. Then children, they are saying, what if RM goes up by 2.5%, which means this 12% RM, what if it becomes 14.5%? Recalculate KE. Students, everything same, but instead of RM that we took earlier as 12, you will take 14.5. So 8 plus 14.5 minus 8 into beta of K, 8 plus 14.5 minus 8 into beta of portfolio will give you the KEs of K Limited and the portfolio. Moving on children, they are saying what if the market goes down by 2.5%? So instead of 12, what if it goes down to 9.5? That is 12 minus 2.5. Then children, we recalculate the entire thing based on the revised RM. 8 plus 9.5 minus 8 into beta of K, 8 plus 9.5 minus 8 into beta of portfolio will give you the KEs for K and the portfolio. And now last, they are asking you, what if the market is giving a negative return of 2.5%? Children, if market is going to give negative return, which means it is now no longer 14.5 or 12 or 9.5, the RM children will be negative 2.5%. No problem, we'll put the numbers here. IRF will remain same. Okay, beta of K and beta of portfolio will take the same. IRF same. It is just that instead of RM, which we took earlier as 12 or 14.5 or 9.5, we'll take negative 2.5. We'll solve it mathematically. We get negative KE for both K as well as the portfolio. So with that, we complete point number 1. Point number 2, they are saying if the probability of market giving negative return is more, please advise Mr. A whether to continue the holdings of K or to buy the portfolio as per the suggestion of B. If so, why? Children, if we are fearing that the market will give negative return, then we would always be safe if our portfolio's beta is low. Because what is beta? Beta is the degree of reaction of our investment to a change in market. Now if market is going down, our portfolio will react in that same fashion, but if the beta is low, then the degree of fall or the percentage drop in our portfolio will be on the lower side. High beta portfolios will drop very much, giving you higher losses. So therefore, now if you compare the betas between K and the portfolio, children, K's beta is given in the question as 1.4, portfolio's beta is 1.015. So obviously, if you are expecting the market to crash, it would be better to remove our money from K Limited and invest in this portfolio since the beta is lower. Everyone clear? So that is what Institute's solution also is. You can see, first of all, they calculated the beta of the portfolio. Then children, they went on to calculate the different K's in different scenarios. Our answers have exactly tallied. Last, if you remember, negative. And then they say if the probability of market giving negative return is more, it is advisable to Mr. A to buy the portfolio suggested by Mr. B because beta of the portfolio is less than K Limited. So with that, students, we complete the discussion to RTP question number 3 based on portfolio management. Let's now go to question number 4, which is again, of course, based on portfolio management. Let's start. This question also, children, a similar question was asked earlier by ICAI. I had shot a video for the same. The numbers are different, everything else is same. So I'll now be presenting that video to you. Kindly watch that video, and after that you will be able to easily understand question number 4. Only numbers are different. Okay, please watch. Hello friends. So now in front of your screens is question number 9. Students, this question, it is there in the
old practice manual. It is also there in your new study material, and children, it came in November 2008 paper for 6 marks. Okay, it's a big question, but it is very easy. Okay, so please pause the video here and read the question carefully. Come on. Okay students, so I hope you all have read the question. Let's try understanding question 9. Mr. A is interested to invest 1 lakh in the securities market. He selected 2 securities B and D for this purpose. The risk return profile of these securities are as follows. So students, they have given us 2 securities B and D, okay, and they have given us the risks of them and the expected return. So basically this is sigma B, this is sigma D, this is B bar and this is D bar. I hope you understood the meanings. Okay, so let us read ahead now. Coefficient of correlation between B and D is 0.15. This is what students is RBD is plus 0.15. Correct? Now they are saying you are required to calculate the portfolio return RP of the following portfolios of B and D to be considered by A for his investment. So one portfolio is 100% investment in B, 50% B, 50% D, third is 75% B, 25% D, and the fourth is 100% D. Also indicate that which portfolio is best for him from risk as well as return point of view, which means students, what you have to do, you have to calculate RP for all 4 portfolios and obviously sigma P for all portfolios. Then from returns point of view, that is RP's point of view, you have to tell which one is the best, which means whichever portfolio gives you highest return, highest RP, that will be the best from the returns point of view. And you have to also tell which one is the best from the risk point of view, which means whichever portfolio gives you the lowest, least sigma P will be the best from risk point of view. So students, let us start, and considering that the correlation coefficient is not perfect, I hope you understood sigma P will be a big formula. So students, let's start understanding. I've put the data now in front of your screens here. So let's start. So the data given is B bar is there, D bar is there, sigma B is there, sigma D is there, and RBD is there. Students, what is the RP formula you will be using? RP will obviously be WB RB plus WD RD, and sigma P, the big one, you will use WB square sigma B square plus WD square sigma D square plus 2 WB WD sigma B sigma D RBD, the whole under root. This formula you will be using. So let's now put numbers and start the question straight away. Students, portfolio 1 that they are telling you is 100% investment in B. Students, if it is 100% investment in B, then the RP will be nothing but B bar only, correct? Because only B is there in your portfolio. So my RP will be 12% and my sigma P will be nothing but sigma of B, that is 10%. Nothing much to calculate here. Let's go ahead. Portfolio 2. Students, portfolio 2 is 50% of B and 50% of D. So RP of course will be 0.5 into something plus 0.5 into something. Let's see what B bar and D bar were. 12% and 20%. Yes, 12% was return of B, 20% was return of D. So 12 and 20, I will put here 12% and 20%, and if you do the calculations, it is 0.5 into 12 m plus, it is 0.5 into 20 m plus, I will get MRC as 16%. Students, I hope you understand. It will be the big root sign calculation now. It will be 0.5 square into something square plus 0.5 square into something square plus 2 into 0.5 into 0.5 into something into the correlation coefficient, that is 0.15. Now students, what is that something? It is nothing but the sigmas, correct? So sigma of B is 10, sigma of D is 18. So sigma B is 10, sigma D is 18. So I'll put the numbers here. 10 square, this is 18 square, 10 and 18. So now let's take the calci and solve this. 0.5 into equal to into 10 into 10 m plus 0.5 into equal to into 18 into 18 m plus 2 into 0.5 into 0.5 into 10 into 18 into 0.15 m plus MRC, and then we root it, we get 10.93%. 10.93%. Okay students, now let's go to portfolio 3. Portfolio 3 is 75% in B and 25% in D. So it will be 0.75 into something plus 0.25 into something. Yes. So let's take the number, students. If you remember, the B bar is 12, the D bar is 20. So 12 and 20 if we take here, let's do the calculation, students. 0.75 into 12 m plus 0.25 into 20 m plus MRC comes to 14% as RP. Very simple. And as far as sigma P is concerned, let's do the calculations. Okay. It will be 0.75 square into, if you remember the sigma P, the sigma B was 10. So into 10 square plus 0.25 square into 18 square. Remember the sigma D was 18. So 0.25 square into 18 square plus 2 into 0.75 into 0.25 into 10 into 18 into 0.15. Now let's take the calcis and solve this. 0.75 into equal to into 10 into 10. Press M plus. 0.25 into equal to into 18 into 18. Press M plus. 2 into 0.75 into 0.25 into 10 into 18 into 0.15 M plus MRC, and then root, we get 9.31%. 9.31%. Very simple calculations, right? And the last one is portfolio 4, 100% in D. Very simple. If it is 100% in D, then do you realize that the RP will be 20% and the sigma P will be 18%. 20 and 18. Let me put the numbers here. 20% and 18%. Yes, 20% and 18%. Now let's do the summary. There is something called as RP, there is something called as sigma P, and there are these portfolios 1, 2, 3 and 4. Let's now pick up the RP, students. So the first portfolio RP was 12 and the sigma P was 10. So I'll write here 12%, 10%. The second portfolio, students, the RP was 16, the sigma P was 10.93. So I'll write here 16 and 10.93. Yes. Portfolio 3, students, if you remember, RP was 14% and sigma P was 9.31. 14 and 9.31. So I'll write here 14%, 9.31%, and the last one, students, RP is 20, sigma P is 18. This is 20%, this is 18%. Now students, come on, tell me, from the point of view of return, RP, what is the best one? The best one is portfolio 4. Yes, so from RP's point of view, the best one is portfolio 4 because it is giving us the highest RP, that is 20%. And from the point of view of risk, students, portfolio 3 is the best because it is offering the lowest risk, that is 9.31. Yes, so for RP the best one is portfolio 4, for sigma P the best one is portfolio 3 since it is giving us the lowest sigma P. Students, I hope you understood this simple question number 9, which came in the exams for 6 marks. Now students, you can pause the video and in front of your screens will pop up the solution to be copied in your notebooks. Thank you so much. Okay students, I hope you all saw the video and I hope you understand this question is very similar to the same. Let's now go to the next question, children, mutual funds. Now question 5 is from the chapter of mutual funds. This question is based on a unique concept called as
dividend equalization. Now what this concept is and how to solve this particular question, I have a detailed video on the same. I'm presenting that in front of you. Kindly watch it. Of course the numbers will be slightly different, otherwise the question setup is exactly same. Okay, so I'm presenting my video on dividend equalization in front of you. Please watch it and then we'll move ahead. So let us now do question number 28. I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. See, I've picked it up from the old PM, but see, it is there in the RTP November 18, RTP May 19, and in November 15 they had asked it for 8 marks. Very important, right? So let's start, and I'm very sure as you read it, you must have seen something different and peculiar. It is not like the normal questions you have been reading till now, okay? So students, question number 28, let me start explaining. On 1st April, an open-ended scheme of mutual fund had 300 lakh units outstanding with an NAV of 18.75. Note the date, end of April, it issued 6 lakh units at opening NAV plus a 2% load adjusted for dividend equalization. At the end of May, 3 lakh units were repurchased at opening NAV less 2% exit load adjusted for dividend equalization. At the end of June, 70% of its available income was distributed. In respect of April to June quarter, the following additional information is available. They are saying in that quarter, the portfolio value appreciated by 425.47 lakh. The income of April students is 22.95. This is the income of the mutual fund, okay? Income for May is given, income for June is given. You are required to calculate point number 1, income available for distribution. Point number 2, issue price at the end of April. Point number 3, repurchase price at the end of May. And point number 4, NAV as on the end of June. Can we start? Students, very simple question, but you need to know how to do it. If it comes in the exam, as it is, it will come in the exam. You should know how to solve it. That is my goal. Yes? So let's start understanding it. Students, what they are saying, the opening NAV is how much? 18.75. Now at the end of April, it issued 6 lakh more units. Yes, it issued 6 lakh more units at whatever the opening NAV is plus a 2% entry load. I am very sure you remember what is entry load. I taught you in the introduction, right? So the opening NAV plus a 2% entry load is the rate at which this new issue of 6 lakh units happened at the end of April. Apart from the opening NAV and the entry load, we are also going to adjust it for the dividend equalization. Yes, students, let us now understand what is this concept of dividend equalization. Can we start? So please pay extreme attention. Students, what are they saying? In April, how much income the mutual fund is going to earn? 22.95 rupees, right? So let's start the understanding. I'll take you straight to the ICAI practice manual solution. Ready? So students, yes, this is the ICAI question 37 from the practice manual. So let us now try to understand it, okay? Students, first things first, what are we going to learn now? The process of dividend equalization. Can we start? So see what they are doing. Students, as far as the April month is concerned, as I told you, the income from April month is how much? 22.95. So that is what they are taking here. See, please pay attention. They are saying income from April is 22.95. Okay. So when income from April is 22.95, okay, do you realize that the total units outstanding are only 300? Where is 300 given? See, I'll show it to you here. 300 units. Here 300 lakh units, correct? Now 22.95, if the total income is being earned in April, that divided by 300 units means a per unit income of how much? 22.95 divided by 300 will give you 0.0765. Till your story is clear. Alright, now tell me students, how many new units are being issued at the end of April? 6 lakh units. So when these 6 lakh units enter into your fund, they will have to pay not only the opening NAV, not only the entry load, but also the dividend equalization, which means that proportionate
existing dividend rate they'll also have to pay. Students, do you realize already I have 300 units and per unit 0.0765 is the income accumulated. So when these people walk in, add dividend equalization collected on issue. When these people walk in, 6 lakh new units are issued, they will have to pay us, apart from opening NAV, apart from entry load, they will have to pay us 0.0765 additional money. That means this money extra I will get as the income from these people. Everybody clear? And therefore, do you realize 306 lakh units will now be outstanding at the end of April, and the total income which will be available with us will be not only what we originally received, but also that we recovered from these people, recovered in a sense which we charged from these people. So the total income available with us is 23.4090, thereby ensuring that the per unit income continues to be 0.0765. Everybody clear? Your goal therefore is to ensure that whenever some new people walk in or you give back the units, the per unit has to remain same, considering the income that you originally hold. Everybody clear? Let's now move ahead. Students, April is done. Let's now move to May. They are saying in the month of May, children, 34.425 income the mutual fund will be earning. So let's now go to May. They are saying add income from May, 34.4250. Obviously, if I divide it by 306 existing units, the per unit comes to 0.1125. This is irrelevant data as of now because we need to see the totals. Okay, so total income already I had 23.4090 plus additional income of 34.4250 gives my total income accumulated at the end of month May as 57.8340. This when I divide by 306 units, do you realize my effective per unit accumulated income is 0.1890, correct? Now children, in the end of month May, what is happening? 3 lakh units were repurchased, bought back, which means the money was given back to them, correct? So when these 3 lakh units were repurchased from the unit holders and money was given to them, we will give them money how much? Can I say we will be giving them opening NAV first of all? Opening NAV is available, correct? From that 2% exit load will subtract. Obviously, everyone understands this. But apart from that, that NAV calculation we'll see later. We are right now focusing on the dividend equalization. Do you realize that we will be giving them their share of the dividend equalization? Everybody following? Which means when 3 lakh units are repurchased, when we give them back their money, we will give them back not only their NAVs adjusted for the load, but also the dividend equalization, correct? Which means when these 3 lakh units are repurchased, we will be giving them their share of 0.1890 rupees per unit back, which is why we say less dividend equalization paid on repurchase. This much amount, students, my income will now reduce. Everybody clear? Yes. So 0.1890 is the accumulated income per unit, correct? And if we are repurchasing 3 lakh units, on 3 lakh we'll have to give back their income. That comes to 0.1890 per unit. Total comes to 0.5670. So 57.8340 minus 0.5670 will give us 57.2670 as the net income at the end of May. And obviously, students, I hope you understand that the outstanding units thereafter will be 303, right? 306 minus 3, and the per unit will not get affected. Everybody clear? Let's now see what happens in June. Students, in the month of June, they are saying the income will be 45.45 rupees, 45.45 lakh rupees. That also will now get accumulated in your existing income. So I add 45.5 to this income from June. This is an irrelevant data. This is nothing but 45.5 divided by 303 outstanding. So the total income accumulated now will be 57 point something upon 45 point something. That is 102.7170 divided amongst 303 units. Can I say the per unit income dividend equalization rate is 0.3390. 102.7170 divided by 303 will give you that amount. Everybody following? Now in the month of June, children, there isn't any new issue, there isn't any repurchase, but something else only is happening. I'll tell you what is happening. They are saying in the month of June, at the end of June, 70% of available income was distributed. So if we are going to distribute 70% of our available income, then students, 102.7170 18.70 is our available income post the income of June. From this 70% will be distributed, that is 71.9019. Students, this is an irrelevant data, don't look at it right now. Yes, that is nothing but 71.9019 divided by 303, doesn't make any difference. But the point is, at the end of June now, the balance income 102 point something minus 71 point something, the balance accumulated income will be 30.8151 divided by 303 existing units. The dividend equalization rate for anything further happening after June in July, which is not forming part of our question, just saying the equalization rate will be 0.1017 rupees per unit. Everybody followed this dividend equalization process. Let's now go on and calculate the NAVs of the individual month ends. So with that, we have completed what, students? Income available for distribution is over. Now one by one, let us knock off these 3 points. So first point, issue price at the end of April. Children, issue price at the end of April will be how much? Do you realize the issue price at the end of April for these 6 lakh units additional that are being issued, yes, will be nothing but opening NAV plus a 2% load that will be charging as entry load, plus we will be also asking from them, recovering from them the dividend equalization, the amount of which we have already calculated, correct? So let's calculate the NAV as on month end of April, at which we will be issuing the new 6 lakh units. Ready? So students, remember 2% load and the opening NAV of 18.75. So calculation of issue price at end of April, opening NAV 18.75, add entry load 2% of 18.75, add the dividend equalization paid by them, that means we will be recovering from them at the time of issue, 0.0765 per unit. I'll show it to you where we have done it. Students, here it is. Yes, see, please focus. Can you see that when the 6 lakh units were issued, we recovered from them at the rate 0.0765 rupees per unit, correct? So per unit that will get added to their issue price, correct? And therefore the final issue price at the end of April will be 19.2015. Everybody clear? Opening plus entry load plus the dividend equalization rate. Final issue price is 19.2015, correct? With that we complete your issue price at end of April. Let us now calculate the repurchase price at the end of May. Students, repurchase price at the end of May, how will we calculate? They are saying that at the end of May, when you repurchase, it will be at the rate opening NAV 18.75 less 2% exit load. Obviously, why less? Because students, if for you it is a sale value, correct? And for you the load has to be paid to me. Do you realize the load will be net off from your sale value, and therefore the net income will be given to you, correct? So for me, when I give you your money back, I will give you opening NAV, but I will deduct that exit load, and then the net I will give it to you. Adjusted for dividend equalization means here, students, in that net NAV that I will be giving to you, I will also add your share of dividend equalization, and I will give the money back to you on the repurchase. What is that repurchase price is what they are asking at the end of May. Children, at the end of May, as you saw, it is nothing but the opening NAV less 2% exit load, and I will add your share of income 0.1890. So 18,750 minus 0.375, 2% of it plus 0.1890. The net final repurchase price for me will be 18.564 as a mutual fund. Students, from where I got this 0.1890 that I am adding to your income when I repurchase, this 0.1890, if you remember, yes, this thing here, add less dividend equalization paid on repurchase. Yes, you can see this data here, 0.1890 from my reserves it is getting reduced, which means for you it is an income, correct? So students, when I say less, it is not less for the unit holder. For you it is add. For me, from my treasury it is reducing, but for you it is an income, correct? So 0.1890 per unit is what I'll be adding on to your repurchase price. Everybody following? It is the repurchase price for me, but for you the redemption price. Everybody clear? So students, with that we understand the issue price at the end of May will be 18.564 rupees per unit. Everybody clear? Then they're talking of the last thing, that is the NAV as on 30th June. Students, they are not saying issue price or repurchase price, because at the end of June nothing is happening. So straight away they're asking you NAV only. What do you think will be the NAV at the end of June, students? students, very simple. It is nothing but the total assets we hold divided by the number of units. Now students, as far as the assets we hold, they are saying that our portfolio has appreciated by 425.47 lakh rupees from the initial means nothing but 300 lakh into 18.75 was my initial portfolio value. In that there has been an appreciation of 425.47. everybody clear? And apart from that, that final net income is also available, right? After the distribution 70%, net income is also available. That also we will add and we'll find the final NAV. Everybody clear? Of course, when I'll be dividing by the number of units, it won't be 300 lakh units now, because you have also raised additional 6 lakhs and you have repurchased 3 lakhs. So basically 303 lakh will be left at the end. Ready? So let's start. Let's see the final calculation. And also obviously, as you will be raising the new funds, 6 lakh units when you will be raising, new fund will come into our bank account, correct? New fund will therefore increase the NAV. When you are repurchasing the units, fund will go out from your bank account. There will be a reduction in the NAV. So basically what all is happening, children? There is an opening balance of 300 lakh into 18.75, correct? Apart from that, there is a new issue of 6 lakh. Apart from that, there is a subtraction, reduction of repurchase of 3 lakh units that will get reduced. Apart from that, there is an appreciation of 425.47 lakh in your portfolio. Apart from that, there is a final net income that is available at the end after the distribution of 70%. Everybody clear? Students will take everything into consideration and then divide by the final units available. We will get the final closing NAV. Everybody following? So students, let's now see the calculation of the closing NAV on June. Opening NAV, I hope you understand, 18.75 rupees per unit into 300. This is the value. Portfolio appreciation they have given to you separately as 425.47. Issue of fresh units 6 into 19.205. From where you got 19.205? Can you see this? New units, correct? At the end of April, the issue price was 19.205 per unit. 6 lakh units we have issued at the rate 19.2015. So this is the additional money that you will receive. Yes, apart from that, the income that we have received. So now let us go on to point number 4. They are asking you NAV as on 30th June. See students, they are not asking you issue price or repurchase price. No, they are only asking you NAV, because at the end of June, you are neither issuing units nor are you repurchasing any units, correct? Straight away final closing NAV as on 30th June. So to explain this, let me first remove all the markings from upstairs. Okay, I will remove everything. And now let me explain. Students, they are asking you NAV as on 30th June. Students, what all has happened from April? Please pay attention. Can I say you already had 300 into 18.75 opening fund value, correct? In that, can I say 6 lakh units were issued new and fresh, and the issue price at the end of April is already calculated by us. So 6 lakhs into issue price is the new fund coming into your company, correct? And in that issue price at the end of April, all the dividend equalization, load, etc., everything is taken into picture, right? Then at the end of May, 3 lakh units are being repurchased. So if you are repurchasing, some of your fund will now deplete, correct? It will go down. And at what rate it will go down? That rate, that repurchase rate is also calculated by us at the end of May. That is also available. And then students, do you realize that you're going to distribute 70% of the available income? That also therefore will reduce your final NAV. Apart from this, correct students, they are saying that our portfolio is going to appreciate by 425.47. This will add on to your NAV. And these 3 incomes, obviously from these incomes only you are distributing 70%, right? So first we'll obviously add these incomes and then the 70% will get distributed, reduced from your portfolio, correct? So I'll again repeat, understand the chronology. First of all, students, do you realize that your original mutual fund has a value of 300 lakhs into 18.75, correct? In that, you will be earning income of April, correct? After income of April, you will be issuing new units at some rate which have already calculated at the end of April. That will also add to your fund value. Then in May, students, you will be earning more income that will add to your fund value, but you are repurchasing some units that will reduce your fund value. Then students, in June, what will happen? distribution. In June, you will be earning some income. That income will add to your fund value, and then in June you are distributing 70% of your total income available for distribution. That will reduce your fund value. And apart from all this, 425.47 is the portfolio appreciation also. That means the portfolio will appreciate by this much value. That will also add to the value of NAV. And finally, students, whatever final net assets we will get, we will divide it by what? We will divide by the closing number of units, which I'm very sure you understand. See, 300 opening units you had, 6 units you issued extra, and 3 units you repurchased. Net closing will be 303 lakh units, at which we'll calculate the NAV per unit. Everybody clear? Let's now quickly complete this, students. See, closing NAV on June, I hope you understand. Opening you have 18.75 rupees into 300 lakh units. This is the value of the opening. Portfolio value appreciation is given to us, correct? Apart from that, there is an issue of fresh units, 6 lakh units at 19.2015. I'll show it to you where it is. You remember end of April, 19.2015 is the issue price. So at this issue price, we are issuing new 6 lakh units. So this additional fund comes into our company. Then total income received of the 3 months given to us in the question. This also adds to the fund. Total fund value gross less units repurchased. 3 lakh units you are repurchasing at 18.564 per unit. 18.564, I hope you remember. End of May, 18.564 is the repurchase price. So 3 lakh units you are repurchasing at that price. So this much fund goes out of our company. Reduction in our fund. Income we are distributing 71.9019. Students, that also we have calculated earlier. I'll show it to you. Yes, you can see here. Total income that you are distributing is 71.9019. That is nothing but 70% of the available income. I hope you remember that. So that also will reduce your fund value, correct? And therefore the total reduction in the fund value will be 127.5939 from this 6268.504. The net value will be 6140.9101. divided by closing units. I hope you understand this calculation. 300 original opening plus 6 new issued minus 3 repurchased, 303 lakh units. My closing NAV therefore will be 6140.9101 divided by 303 lakhs will give us 20.2670 rupees. Everybody clear? So with this, students, we finished the dividend equalization process also. I hope you understood. I was very hell-bent on teaching you this because, students, you should know what it is. Because if in case this comes as it is in the exam, which as it is only it will come hopefully, do you realize you should know how to solve this? Hence, I took you through this. Now you are ready. I will now flash the solution of this question on your screen. So you can pause the video and copy down the solution. And as you are copying down, please understand it once more properly, logic by logic, so that whenever it comes in the exam, you can easily knock it off. 8 marks are going nowhere. Let us check how many marks it has come. Students, I'll show it to you here. I have written it down here. Yes, it is a 8 marks question. Yes. So students, 8 marks available for you straight away. I am very sure many of your friends who are not watching this video. See, in our SFM syllabus, do you realize we are covering everything possible? All the nooks and corners, anytime, anywhere, some different conceptual question the institute has asked, I am placing that in front of you so that you know what all has been asked, has been seen in the previous attempts in the different ICAI materials. You should know everything. Hence, I am showing you this. Now you are ready. Yes, our mutual fund chapter is now almost over. There is nothing much left here. Things will now start going downhill. Miscellaneous last parts are left. Okay. So thank you very much. You can pause the video and copy down the solution.
Okay, students, I hope you understood how to solve the dividend equalization question. Let us now move on to the next. Children, derivative analysis and valuation. Both these questions, 6 as well as 7, are very famous questions asked in the past. Right? I have got videos already recorded for these type of questions. For question number 6, children, slightly numbers will be different. Otherwise, the setup is same. And question number 7, the numbers are also same. Okay, so children, these two questions I will now present it in front of you from my video library. Please go through them. You'll be able to easily understand both questions of derivative analysis and valuation of RTP. Please watch. This is one miscellaneous question I picked up from the ICAI practice manual. This is connected to not only strategies but also speaking on a more generic sense. It is a payoff table question. Okay, payoff tables and strategies, I'm very sure you understand, are on a similar scale only. So students, I request everyone to please pause the video and just read through this question once. Start.
Okay, students, I hope you all read this question. Let us now try to understand it. Mr. X established the following spread on the Delta Corporation stock. He purchased one 3-month call option with a premium of 30 and an exercise price of 550. Okay, so they are saying that he is purchasing one 3-month call option, premium is paying 30, strike price is 550. He's purchasing another one 3-month put option with the premium of 5 and an exercise price of 450. So he is now purchasing one call and one put, correct? Next, let's go ahead. Delta Corporation stock is currently selling at rupees 500. This is S0. Determine profit or loss if the price of the Delta stock is remaining at 500 after 3 months, falls to 350 after 3 months, rises to 600 after 3 months. Assume the size of the option is 100 shares of Delta Corporation. Students, this is a very similar question that we have done in the payoff table section. Simply, we have to calculate the net payoff and then add the net payoffs of both the call and the put, and that is your final answer. 3 times you'll have to do because 3 levels of S1 are given to us, correct? So let us do at the first level of S1 that what if the S1 remains at 500 on due date. Can we start? So students, question 65, calculation of net payoff, case 1, if S1 is 500 on due date. Let us first knock off the call. Students, what is S1? S1 is 500. What is K for the call? The K, can you see, is 550. So I'll write down here 550. Tell me, what is the option status? S1 is less than K. It is out of money option. What is the gross payoff? 0. How much premium you have paid? Students, premium paid for the call option given to you is 30. So I pay 30 and therefore my net payoff, students, will be negative 30. That is a loss of 30, correct? Going to the put option, can I say the S1 is 500? What is the K for a put option? The K for the put option is 450, correct? I'll write down here 450. The S1 is above K. If the S1, students, is above K, can I say the put option is also out of money? I'll write down OTM. Therefore, gross payoff is 0. Premium paid for the put option, students, is 5. So I'll write down here 5 and my net payoff is negative 5. Everybody following? Can I say, considering the fact that there are 100 shares of Delta Corporation per option, that is the lot size is 100, can I say my final payoff, okay, final payoff will be 30 into 100, correct? This is the loss total on one option of call plus 5 into 100, total loss on one option of put, correct? So this is 3000 negative plus 500 negative, total loss of 3500. Everybody following? 3500 therefore is the loss that you are suffering if the S1 remains at 500 on due date. Everybody clear with this? Let us now go to the next case. Next case, what are they saying, students? What if the S1 touches 350 in 3 months? So students, case 2, if the S1 is 350 in 3 months, tell me what is S1 for call? 350. What is K for the call? The K is 550, correct? So I'll write down 550. The status of the option obviously is out of money since the S1 is less than K. The gross payoff, therefore, students, obviously will be 0, less the premium paid. How much premium are you paying per call? The premium you're paying is rupees 30. So I'll write down here 30. Therefore, students, the net payoff will be a loss of 30. Everybody following? In a call option, if the S1 touches 350, you are suffering a loss of rupees 30. Let's see for the put. The S1 obviously is 350. As far as the put K is concerned, it is 450. Okay, finally, S1 less than K, the put is in the money. The gross payoff obviously will be K minus S1, that is 450 minus 350, that is 100. The premium you're paying for the put option, students, is only rupees 5. So I'll write down here 5 and the net payoff will be 100 minus 5, that is 95. Everybody following? Can I say therefore my final payoff will be 30 into 100 shares, correct? That is a loss from the call, plus 95 into 100 shares, that is the gain from the put. So it is negative 3000, correct? plus 9500. Yes, if we take the calces, minus 3000 plus 9500, we get a gain of 6500 from this strategy if the S1 touches 350. Everybody clear? With that, we complete point number 2. Students, point number 3, what if the S1 rises to 600? That is your case 3. Yes, this particular case, students, I'm giving it to you as a test. Kindly start and get me the final payoff. Okay, your time starts now. Pause the video and start. Okay, students, I'm very sure you're ready with your answers. I will now flash the solution of this question 65 on your screen. So you can pause the video and copy down the notes for the first 2 and tally your notes for the third. I'm very sure your answers are right. Okay, no scope only here left for making any mistake because I've explained everything to you in depth. Yes, thank you very much. Tally your answers. Hi friends, so welcome to one more video, question number 65. This question also I gave you as a test, only the point number 3. Very simple question, students. Let's now first read it and then solve point number 3, because points 1 and 2 I have already discussed in the earlier original video. Yes, so Mr. X established the following spread on the Delta Corporation stock. He purchased one 3-month call option with a premium of 30 and exercise price of 550. He purchased another 3-month put option with a premium of 5 and an exercise price of rupees 450. Delta Corporation stock is currently selling at rupees 500. This is your S0. Determine profit or loss if the price of Delta Corporation stock is going to rise to 600 on the due date. So if this is S1, they are asking you what is your final net payoff, assuming that the size of the option is 100 shares on Delta Corporation. Can we start the basic payoff table? Okay, the net payoff table you have to make and get the net profit. Can we start, students? So I'm writing down here question number 5, point number 3. If S1 rises to 600, okay, if S1 rises to rupees 600, children, I'll write down here particulars. Okay, then there is call and then there is put. Tell me what is the format. We first of all write down S1, then we compare with K, then we understand the option status, with which we then calculate the gross payoff. Correct, children? From gross payoff, can I say we subtract the premium paid and then we get the net payoff. Everybody following? And then of course the total net payoff will multiply by 100 shares to find out the total net payoff. This, of course, this particular table will be doing on a per share basis. So tell me, children, S1 will be what? S1 in this particular case we are taking as 600. So can I say 600 I will take now. Now as far as exercise price is concerned, children, strike price here K is 550 for a call and 450 for the put. So 550 and 450, I'll write down here 550 and 450. Correct. Now children, tell me, as far as call is concerned, can I say S1 is more than K, higher than K, greater than K, and therefore the call, children, will be in the money. As far as put is concerned, can I say S1 is above K, and if S1 is above K, can I say the put becomes out of money. Everybody following? Now children, gross payoff. Students, we have bought a call here, and therefore for a call option buyer, in the money call means the gross payoff will be S1 minus K, 600 minus 550, that is 50. And as far as the put option is concerned, because it is out of money, the gross payoff will be 0. Everybody following? Now as far as premium paid is concerned, for call we are paying a premium of 30, for put we are paying a premium of only 5. So children, can I say, I'll write down 30 and 5, and therefore my net payoff, yes, for one share in the call option is 20 and negative 5 for the put option. Children, have to just multiply this by number of equity shares, that is 100 and 100. I get the total net payoff. Okay, total net payoff will be 20 into 100, that is rupees 2000, and negative 5 into 100, that is 500. Can I say 2000 minus 500, 1500 rupees? Yes, 1500 rupees will be our total net pay off from this particular strategy. Everybody following? Very simple question rest. So with that, students, we complete this discussion of the test part to question number 65. I hope you all understood this part. Thank you very much, students. See you in the next video with another question which I gave you as a test in this chapter of derivatives. Thank you so much. Hi friends, now one more question, question 21. Look at this, I've picked it up from the old PM. It came in November 7 paper for 8 marks, then RTP November 15, RTP May 16, old RTP May 19. The same to same question is there. Students, I request everyone to please pause the video and read this question very carefully, please. Okay students, I hope you all have read the question. Let us now try to understand it. See, they are saying given the following information, they are saying BSE index is 5000, correct? 5000, this must obviously be points and this must obviously be the S0 which we used to call as I0 spot market index, okay? Next students, they say value of portfolio rupees 10 lakh 10,000. This is like that asset, the value of the asset you hold, the portfolio of shares. Remember that this is the asset you want to hedge, correct? Risk-free interest rate R given is 9%. Yield Y. You remember Y in the index futures I told you that when you do E raised to R minus Y you should do, correct? That is 6% and the beta is 1.5. This is your hedge ratio. We assume that a futures contract on the BSE index with 4 months maturity is used to hedge the value of the portfolio over the next 3 months. I'll tell the meaning of this line in some time. One futures contract is for delivery 50 times the index. What do you think this must be? Multiplier. Yes, you're right. Based on the information, calculate price of futures contract. Students, point number B, we will see later. Right now, they're asking us price of the futures contract. Now, students, please understand. I'm writing here question 21. See, this is the spot market. This is the derivative market, okay? Now, students, let's say this is today. This is after 3 months. This is after 4 months, okay? Today, after 3 months and after 4 months. In the spot market, you have an asset that is your portfolio of shares, correct? You are saying that this portfolio you want to hedge over the next 3 months. What does that mean? That means it is your desire that you will be selling off, liquidating your portfolio in 3 months time, okay? You will be selling off, liquidating your portfolio in 3 months time. So students, do you realize that you are now looking for S1 here? You don't know what is S1 here. Not here, correct? Because you're not going to wait till the end of 4th month. You're going to liquidate your portfolio in the cash market, in the spot market in 3 months time only. So to hedge this, you went and sold futures. Of course, correct? You will go and sell futures. But the futures that were available, students, the futures were available on the index, that is BSE index. Students, the moment you are using index futures for hedging your spot market asset of a portfolio of shares, do you realize it is a cross hedging happening here? But the problem is that the index futures due date is 4 months, okay? The index futures due date is 4 months, which means this has a due date here, correct? 4 months is the due date. But no problem. Anyways, you know that the futures are liquid. When we are selling off S1, we will close out our position in the futures market at the end of month 3 only. We will not be going till the end of month 4. I hope you understood. All right. So now this is the scenario. And now they are asking you point number 1. What is the price of the futures contract? Students, price of the futures contract means they are asking you what is the value of the futures contract, the index futures. Students, index futures today, that is F0, they are asking what formula will I use? Obviously, I will use the formula. I'll write down here. Theoretical value of an index future is equal to I0 into E raised to Rn. But students, I am very sure you saw that there is a Y also here. So I'll do R minus Y the whole into N, correct? The yield will be subtracted from the cost. Let's go ahead. What is your I0, students, here? Your I0 in the spot is 5,000 points. So I'll write down now here 5,000 points. So please understand that in the spot market, the index is trading at 5,000 points, using which we are now going to estimate the F0 of the derivatives market. Everybody following? So it will be 5,000 into E raised to, what is R, what is Y, what is N? Students, your R is 9%, your Y is 6%, and your N, students, tell me now, what about N? do you understand that when I'll be valuing these futures, the valuation of the future, do you realize, is irrespective of your time period in the cash market? Now you are saying in the cash market I'm going to hold the asset for 3 months. But students, the valuation of the futures will happen on the basis of the futures period, correct? And the futures period is not 3 months. The futures period is 4 months, correct? So therefore, I will write R is 9%, that is 0.09. Correct? Your Y is 6%, that is minus 0.06 into 4 months, that is 4 by 12. I hope you understood, okay? So which is equal to 5000 into e raised to, so it is 0.09 minus 0.06 into 4 divided by 12, that is 0.01, e raised to 0.01, correct? So let me do the calculations now. 2.71828, press root how many times? 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 minus 1 into 0.01 plus 1 into equal to 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. That will give me 1.01. Everybody following? So it will be 5000 into 1.01. And therefore I get 5000 into 1.01, that is 5050. Students, what is 5050? These are 5050 points, and this is the F0 that must be trading today. Yes, today means, I'm very sure you understand, today is here, okay? This is F0, 5050 points. So you enter into the futures market today and you sell futures at the rate 5050. Everybody following till here? Great. This answer obviously we got as 5050 points, correct? And now, do you also understand that the multiplier is 50 units, correct? If you remember, the multiplier is 50 units. So therefore, if I want to find the value of one futures contract, it will be 5050 into 50. If we do, we get rupees 2,52,500, okay? Rupees 2,52,500. Is the story clear till here? This is the price of one futures contract, which is what we got. That is point number A. Let us now jump to point number B. The gain on short futures position if the index turns out to be 4,500 in 3 months. So they're saying what will be the gain when you close out your short futures position if the index turns out to be 4,500 in 3 months. Students, for this a lot of attention is required. Please focus very hard. Can we start? Okay. So I'll write down here spot market, derivative market, okay? In the spot market, there is the asset that you want to hedge the portfolio, and there is this index. And in the derivative market, there is the index futures, okay? In the derivative market, there is the index futures. Students, today, your asset today is worth how much, students? This number, how much should I write? Do you remember in the question we had read, the value of the portfolio today is 10,10,000. Till your story is clear? Great. So I'll write down here 10,10,000. Done. Students, index today in the spot market obviously is 5,000 points. 5,000 is not the derivative futures price, correct? It is the actual spot market points of the index, that is 5,000 points. So I'll write down here, your index is 5,000 points. This is rupees 10,10,000 and index is 5,000 points in the spot market. On the other hand, students, today your index futures are trading at 5050 points, correct? 5050 points, and the multiplier is 50 units. Everybody following? And these are obviously 4-month index futures, correct? 4-month index futures. Now students, what is happening? You are long on an asset in the spot market worth 10,10,000 rupees, correct? You know that you want to sell this asset in 3 months' time. You do not know that how much price you will receive in 3 months' time. So there is an uncertainty as far as your future selling is concerned, correct? So therefore, to hedge your future selling, you approach the derivative market to sell futures. In the derivative market, we do not find a futures exactly on our portfolio, which of course you will not find, but you find index futures, which you therefore decide to cross hedge, correct? You decide to sell 4-month index futures, which are trading at 5050 points. Students, before I go ahead, I hope you also understand I cannot blindly sell futures here. I have to first of all calculate the number of contracts I wish to sell, because as I have taught you, it is a cross hedging, correct? In a cross hedging scenario, we will have to find out the number of contracts. So I'll write down here number of contracts, okay, to be sold will be, what is the formula, students? Beta into VA by VF. Your beta, students, if you remember, is 1.5 times, correct? Your beta is 1.5 times. I'll write down here 1.5 into value of asset, of course, is 10 lakh 10,000, and the value of one futures contract we have already calculated it to be 2,52,500. I hope you remember this calculation. 5050 into 50, 252,500. I'll write it down here, 252,500. Let us calculate first of all how many contracts we have to sell for hedging. Students, it will be 1.5 into 10 lakh 10,000 divided by 2,52,500 will exactly give you 6 contracts. Okay, so therefore today we will sell 6 4-month index future contracts at the rate 5050 points with a multiplier of 50. Till your story is clear? Amazing. Now comes at end of month 3. End of month 3, students, let's see what happens. They are saying that the gain on the shorts futures position, if the index turns out to be 4,500 in 3 months. Oh, that means they are not mentioning about what is happening in the asset, that is the spot market. They're not even asking you. They're not mentioning, they're not asking. They're only asking in the futures position, what is the gain or loss? See, read the question again. What is point number B saying? The gain on the futures position if the index turns out to be 4,500. So what I have to only do is, to hell with the cash market, I have to only think about the derivative market. In the derivative market, when I close out my position at the end of the 3rd month, is there any gain or is there any loss? Can we start? Now students, the mistakes that students do at the end of the 3 months, they feel that the F. Students, I hope you understand, at end of month 4, the futures will mature, correct? But I am not going to stay till the end of the 4th month. I am going to knock off the futures at the end of the 3rd month itself. And these futures, what is the value of it? Some people think it is 4,500 as given in the question. The index turns out to be 4,500 in 3 months. Children, no. It is not the value of futures. Just as they had given to us the BSE index 5,000 points in the spot market today, they are saying that this 5,000 in the spot market, the index has turned out to be 4,500. They are not saying that the index contract, the futures price is 4,500. No, the index is 4,500. Therefore, do you realize that this index of 5,000 points in the spot market has now dropped to 4,500 points in the spot market? This understanding is wrong. Everybody following? But do you therefore also realize that I have nothing to do with this 4,500 points? I want this price, the futures price. Now how do I get it? Because the question is saying that when you close out the futures at the end of month 3, when you close out the futures at the end of month 3, you had taken a position at 5050. You had shorted the futures, right? You had sold futures at 5050. At the end of month 3, you will buy the futures, correct? At whatever the futures price is trading here, which is what I don't know. But corresponding spot price, 4,500 points they have given to us at the end of month 3. What to do? Students, very simple. I am very sure many of you have understood also. Just as today also, where had they given to us 5050? They had not given. They had given the spot price only 5,000. Using 5,000, we first calculated this 5050. Do you remember this? We first calculated the 5050 using this formula where the N obviously was 4 by 12, because from today till the due date of the futures, the value would be calculated for a 4-month period. Similarly, yes, you are all right. Similarly, this 4,500 now, students, do you realize it is like today now? Today the price is 4,500 points in the spot market. I want to know what will be the value of a 1 month futures contract. Did you understand? 1 month. Why, students? Because from 4,500 today, there is only 1 month left for the maturity of the futures contract. I am not concerned. See, when I am valuing the futures contract, I am not concerned what is my holding period in the spot market. The futures contract valuation will obviously happen on the basis of the due date of the futures contract, not your due date in the spot market. Everybody following? So as far as the futures are concerned, children, do you realize that if the spot index has turned out to be 4,500, it is absolutely not necessary that the futures also will be 4,500 because the due date has not yet come. The spot and the futures have not yet converged. Students, do you realize that at the end of month 4, if this 4,500 drops to 4,200, then I can say yes that the F1 will also be 4,200 because F1 and S1 will converge. It's due date time. But before 1 month, that is 1 month before due date, that is at the end of month 3, when the spot has turned out to be 4,500, do you realize you cannot take F as 4,500? You will have to calculate F just as you calculated the F here to find out 5050 using the spot index. Everybody understanding? So therefore, let us take this 4,500 and let us calculate what is the 1 month futures as on this date. Can we start? Same formula to use, students, just that the n now will not be 4 by 12, it will be 1 by 12. So I'll write down now here, theoretical value of futures is equal to I0 into e raised to r minus y into n. Your I0 now, children, will be 4,500 into e raised to 0.09 minus 0.06. I hope you remember r minus the yield, correct? So into n, what is your n now? Only 1 month is left, correct? From 4,500, the compounding has to happen only for a period of 1 month. I hope you remember theoretical valuation of futures modules, okay? So now this is 0.09 minus 0.06 divided by 12, that is 0.0025. So I'll write down here 4,500 into e raised to 0.0025. Let's do the calculation, students. 2.71828. Let us press the root sign 12 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1 into 0.0025 plus 1 and then into equal to 12 times. Into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 and 12 will give me 1.0025. So it is 4,500 into 1.0025. If you take the calci, 4,500 into 1.0025 will give me 4511.25. okay, 4511.25. Students, what is 4511.25? This will be the F0 at end of the 3rd month, which means it is this price here of the futures, 4511.25, correct? If the spot is 4500, considering 1 month period left, the theoretical value of the futures should be 4511.25, which I'm assuming to be the actual value also. So students, I'll write down now here, therefore gain in the futures position. Why am I writing gain so confidently? Because the question only has said, not only because the question has said, you can also see here, correct? See, now students, let us close out the futures position because that is what they're asking in the question, right? They're asking you what is the gain on the futures position at the end of the 3 months, which means you'll be closing it out, right? So to close out, let's do the calculations. I'll write down your original position. Come on, students, what was your original position? Your original position was sell the futures at the rate 5050, correct? To close out now, you will buy futures at the rate. What is the price of the futures now when you're closing out at the end of 3rd month? 4511.25. 4511.25. Sell at 5050, buy at 4511.25. There is a clear-cut gain. Students, tell me how many contracts should enter into? 6. You remember that? And the multiplier was how much? 50 units, right? 50 units. So I'll write down now here. It is basically F0 minus F1 only we have to do, correct? At F0 we had agreed to sell, at F1 we are closing out by buying. So it was 6 contracts into 50 units into 5050 points. This was F0 minus 6 contracts into 50 units into 4511.25. Yes. So students, let us do the calculation now. I'm very sure I can do little bit mathematics here for fun. 6 contracts into 50 units into 5050 minus 4511.25. Same thing it is, correct? So 5050 minus 4511.25 into 50 into 6 will give me 1,61,625 rupees gain. 161,625 is the gain in your short position closeout. Yes, to close out a short position, you have to take a long position. Buy, correct? Original was short. To cancel, to close out, we buy. The gain we are enjoying in the futures market is 1,61,625. Yes, and with that, students, we complete your question number 21. Very important question. You can see from the ICAI reference here. I will now flash the solution of this question on front of your screens. You can copy it in your notebooks. Thank you very much. We'll see you in the next video with another question on cross hedging. See you there.
Okay students, so now this question number 8 is from the chapter of Forex, that is foreign exchange exposure and risk management. Let us try to understand. They are saying a US investor chose to invest in Sensex, which means a US guy is investing in India for a period of 1 year. The relevant information is given below. So children, he has invested $20 lakh, okay, invested $20 lakh when the spot rate was $1 equal to rupees 42.5-42.6. The spot rate today is 43.85-90. When he invested the $20 lakh, the Sensex was 3256 points, and today the Sensex is 3765 points. They're asking you, compute the nominal rate of return to the US investor. Now children, if I have to calculate the return for the US investor, we will have to know how much dollars he invested today and how much dollars it grew to at the end of 1 year, and then we will be able to find out the return for the US investor. Now children, do you realize he first says that he wants to invest $20 lakh in India. Now children, do you realize, therefore, to convert the dollars to rupees, he will have to go to the bank today and sell dollars. He will sell dollars at the bid rate of dollar, that is $1 equal to rupees 42.50, correct? And he will get rupees. So children, if you can see here, $20 lakh he gets to India. At the rate 42.5 rupees per dollar, if he converts the dollar to rupees, he ends up getting 8 crore 50 lakh rupees. These 8 crore 50 lakh rupees, children, he invests in the Sensex, which is trading at 3256. So 8 crore 50 lakh divided by 3256, he gets 26,105 units. These 26,105 units he is holding for 1 year, and today the value of each unit now is 3,765. So the value of his investment in rupees at the end of 1 year will be, that is today basically, will be 26,105 multiplied by 3,765 will give a value at the end of first year, that is today, of rupees 9 crore 82 lakh 85,325. These rupees he will convert back to American dollars. Children, now he wants to buy dollars, correct? He wants to buy dollars, and therefore the relevant rate will be the ask rate of dollars, that is $1 equal to rupees 43.9. That is today's rate, correct? $1 equal to rupees 43.9 is the rate at which he'll convert the rupees to dollars, and it will end up at $22,38,846. So basically, from the American's point of view, he invested $20 lakh today, or basically 1 year back, and today it has grown to $22,38,846. So children, therefore, do you realize that he is earning a percentage return of 22,38,846 minus 20 upon 20 into 100, that is 11.94%. Everyone clear? Now the question arises, sir, what is the meaning of this word nominal? Nominal means, see, they are saying that inflation in US is 5%. So what is the International Fishers theory saying? It says that your return, whatever return you're earning from any investment, is called as nominal return. But if there is inflation also, that means your nominal return is not your real return. Your real return will be less than the nominal return. The formula is given as 1 plus R, that is real return, into 1 plus inflation will give you the total return, that is 1 plus nominal return. So here children, here we are earning a nominal return of 11.94. Considering there is a 5% inflation, we could have easily found out the real return also, but they are simply asking you to find the nominal return. That point is over, right? Now children, I would like to go to point number 3. Point number 2, I will take it up in some time. They are saying, what should be the exchange rate if the purchasing power parity holds good? Now children, according to purchasing power parity, you know that 1 plus home inflation rate upon 1 plus foreign inflation rate will be forward upon spot. Everybody knows this. Now students, here they have given to you the inflation rates as well as the spot. Children, if I take the base spot here, correct, the base spot, $1 equal to rupees 42.5, correct? I'll take here, okay, I'll take here 42.5, okay, and considering that I have taken the rupees here as the price, we will consider India as the home for the purpose of calculation, right? If we would have taken dollars here, then we would have considered US to be the home, right? So moving on children, tell me what is the inflation rate for India RH? It is 9%. So here we will write down 1.09, and for US, that is foreign, it is 5%, that is 1.05. Using this children, can I say we will be able to find out the theoretical forward rate which should be the rate in 1 year's time, that is today, according to PPPT, purchasing power parity theorem. You will have to do this calculation twice, one for 42.5 and one for 42.6. Children, this is like spot and this is like the forward in a sense in 1 year's time. So students, let's do it twice, one for bid rate, one for ask rate. I've done it here, okay. 1 plus RH upon 1 plus RF is equal to F upon S0. This is for the bid rate, this is for the ask rate. If we solve this, we get the theoretical forward as $1 equal to rupees 44.1190 dash 44.2229. Now students, I want you all to be paying attention here. This is very important now because I want you to understand point number 2, which is pending. If you see the spot bid rate and the forward bid rate, can I say that dollar appears to appreciate, correct? Yes, $1 which was 42.5 according to PPPT will go to 44.19, and same appreciation you can see, or a similar appreciation basically you will see in the ask rate also, from 42.6 to 44.2229. First question is, why is dollar appreciating? Can I say the other half could be, why is rupee depreciating against each other? Why is dollar appreciating against rupee and why is rupee depreciating against dollar? The reason lies, yes, in the inflation rates. Children, if you can see here, okay, if you can see here that the inflation rate in US is only 5%, whereas that in India is 9. According to PPPT, the country whose inflation rate is lower as compared to the other will experience appreciation in their currency, whereas the country whose inflation rate is higher than the other will experience depreciation. So therefore, according to PPPT, dollar should appreciate from 42.5 to 44.19. That much appreciation should happen, correct? And that means that much corresponding depreciation should happen in rupee. But now children, if you see, okay, if you see what happens in reality. In reality, yes, dollar does appreciate. It is appreciating from 42.5 to 43.85. Are you listening? It is going from 42.5 to 43.85, which means, do you realize, according to PPPT, dollar should have appreciated slightly bit more, right? From 42.5, it should have gone to 44.11, but here it is going only till 43.85. Similarly, if you check for the ask rate, from 42.6, According to PPPT, it should have gone to 44.2229, but it is going only to 43.9, which means the appreciation in dollar which should have been there, okay, that appreciation in dollar which should have been there, according to PPPT, that much appreciation is not happening. So this is appreciation in dollar and this is corresponding depreciation in rupee. In reality, what has happened? Dollar has appreciated but slightly less. Everybody clear? And can I therefore say that rupee has depreciated but slightly less? Everybody clear till here? Slightly less. That much depreciation in rupee has not happened, which PPPT had anticipated. So now they are asking you in point number 2, compute the real appreciation of rupee. Children, do you realize according to PPPT, rupee, okay, I'll just mark this again, rupee should have depreciated this much, but can I say it has not depreciated this much, it has depreciated only this much. Everybody clear? And therefore, do you realize that there is a slight appreciation in rupee which is special? Considering PPPT and inflation rate theory, rupee should have gone down further, but because it has not gone down that much, it has slightly come up, or basically the going down has been stopped in the middle. How much is that appreciation? This part, how much is the appreciation in rupee is what the question is asking. So let us try to understand how to solve this, children. Ready everyone? So even if you see corresponding, dollar should have appreciated this much, but slight depreciation in reality has happened, due to which the appreciation is only this much. Everybody are able to get it? So if I put numbers here, okay, dollar which was 42.5 here should have gone to 44.119, but can I say it from here has dropped to a reality of only 43.85. So do you realize there is a slight drop in dollar, slight depreciation? Similarly, there must be a corresponding slight appreciation in rupee. Let us try to find out. Ready everyone? So I'll just remove all these markings for all of you. Okay, I'll remove all these markings and now let me just put the numbers. Students, here actual spot rate today, as we saw, is 43.85 and 43.9. In order to understand the depreciation in rupee, we will first of all convert everything into a quote where the rupee is the product and dollar is the price, that is indirect quotes. Okay, so as per PPPT, according to PPPT, $1 should have been equal to 44.19, 44.2229, which if I convert to indirect quotes, this is what the rupee should have looked. Everyone clear? It should have been $1 equal to rupees 1 upon 44.2229 dash 1 upon 44.1190. But in reality, can I say $1 has become rupees 43.85 dash 43.9. So in reality, the actual rupee rates are 1 rupee equal to dollar 1 upon 43.9 dash 1 upon 43.8. Children, do you realize that rupee in reality is slightly more than what it should have been as compared to the PPPT rates? Everyone clear? Yes. So now we have to realize how much has rupee appreciated as compared to the rate which PPPT is professing here, right? So children, as far as bid rate of rupee is concerned, can I say it is 1 upon 43.9 minus 1 upon 44.2229 divided by 1 upon 44.2229 into 100, we realize that rupee has slightly appreciated by 0.74%. And the same if we check for the ask rate, 1 upon 43.85 minus 1 upon 44.1190 upon 1 upon 44.1190 will give you appreciation of 0.61% in the ask rate for rupee. Now children, if you see ICAI's solution for the same, they have not done this. Okay, they have only done for this part, the ask rate of rupee. In that also their solution is slightly different, but the answer is of course telling. Can I show it to you? See, this is your question number 8. Now if you see point number 2, they have only calculated one part, that is 0.61, which we have also received, correct? Their methodology is slightly different. This part they have completely ignored. Okay, let's move on. Children, the last point number 4 that they are asking, okay, what will be the real return? Okay, what will be the real return to an Indian investor in Sensex? So now forget from the Americans' point of view, there is an Indian investor. What will be his return? Now first of all, let's calculate nominal return. Children, do you realize nominal return will be, if we invest 3256 today, it will grow to 3765 in a year. So students, do you realize from an Indian investor's point of view, nominal return will be 3765 minus 3256 upon 3256 into 100, that is 15.63%. But considering the fact that there is a 9% inflation rate in India, the real return that the investor will be earning, that is the increase in his actual purchasing power, will be slightly less than 15.63. We put this formula I showed you some time back. 1 plus R into 1 plus I is equal to 1 plus N. 1 plus N is 1.1563. 1 plus I is 1.09, that is 9%. You can easily find the R as 6.08%. okay, 6.08%. Of course, again, institute's methodology is slightly different, but they end up with that same answers. Everyone clear? So don't worry. So with that, we complete the discussion to question number 8. And now let us proceed to question number 9. Okay, so students, the next question, that is question number 9, is also from Forex. It's a new question. Let us try to understand. Mr. Mamin, an Indian investor, invests in a listed bond in USA. So children, the previous question was where a USA guy was investing in India. Now an Indian guy is investing in USA. If the price of the bond at the beginning of the year is $100 and it is $103 at the end of the year, the coupon rate being paid is 3% annually. Now children, do you realize that if this Mamin guy invests in USA, do you realize that his return eventually will be, see, he has invested $100, he will get back 103 at the end of the year, plus $100 into 3%, assuming 100 is the face value. Can I say $3 coupon he will get? The whole upon 100 into 100. Children, this is the return that Mamin will get. Everybody clear? $3 is the capital gains and $3 is the other sources, that is the interest. And therefore, children, this is the calculation for his return if he was to calculate the returns in dollar percentage terms, right? But here, considering that he is an Indian, we will have to consider the return in rupee terms, for which we will also have to take into consideration the exchange rate fluctuations. Institute, of course, has given some shortcut answers. I have gone slightly long cut to help you understand what it is all about. If you're comfortable with ICI solution, then the best. Okay, moving on. Find the return on investment in terms of home country currency, that is in rupees, as I told you, if point number 1, USD is flat, or if USD appreciates during the year by 3%, or if USD depreciates during the year by 3%, or if the Indian rupee appreciates during the year by 5%. So children, these are the 4 cases. Fifth one is one-liner answer. We'll talk about it later. These are the 4 cases. So students, what I have done is, first of all, let us assume, okay, that $1 is equal to rupees something. Let's start with something and then we'll able to understand the calculations. I have assumed $1 equal to rupees 50 as the spot today. You can take anything you want. Of course, the answers will come same only, because at the end of the day, it is a percentage, right? So children, I am assuming that $1 is equal to rupees 50. And children, therefore, if I take case 1, that US dollar will remain flat, which means it will remain 50 only at the end of year 1. So students, this is the solution. Okay, spot rates. Today, okay, in case 1, of course, $1 equal to rupees 50 is an assumption. In case 1, since the US dollar remains flat, do you realize that at end of year, that is end of year 1, US dollar will continue to remain rupees 50. So students, do you therefore understand that his calculation of return for the first year will be, now children, what you see in red are the dollars, correct? $103 at the end, $100 invested today. Yes, children, do you realize $3 will be the interest he will get? But considering the rates, do you realize he will be able to convert these into rupees at 50 both today as well as at the end of year 1. So 103 into this 50 minus 100 into this 50 plus 3 into this 50, because that $3 you will get at the end of first year, the whole upon 100 into this 50. Children, do you realize will give a return of 6%? Of course, multiplied by 100 overall will give a return of 6%. That is exactly, children, that ICAI has got right as 6%. Now students, I'll go to point number 2. Point number 2 is where they are saying, what if the dollar appreciates by 3%? So children, if dollar appreciates by 3% in case 2, do you realize spot rate is $1 equal to rupees 50. If it appreciates by 3%, it is 50 plus 3%, that is rupees 51.5. Then children, do you realize the return will be $103 into 51.5 minus 100 into today's spot rate 50 plus 3 into 51.5, that is the end of the year, divided by 100 into 50 into 100 will give you 9.18% as the return for case 2. If you check institute solution, 9.18%, right? Moving on students to case 3. Now what is case 3? US dollar depreciates during the year by 3%. Now children, if dollar depreciates during the year by 3%, do you understand that if today $1 equal to 50, in 1 year it will be 50 minus 3%. Everybody clear? And 50 minus 3% will give you rupees 48.5. We'll recalculate the return. $103 into 48.5 minus 100, correct, into 50 plus 3 into 48.5 upon 100, correct, into 50. Children, do you realize that will give you a return as 2.82%. Now this also, if you see from institute solution, 2.82%. Now students, moving on to the fourth point. What are they saying in the fourth point? They are saying, what if the Indian rupee appreciates by 5%? Now children, if Indian rupee is going to appreciate by 5%, we will have to first of all convert the spot rate to an indirect quote where rupee is the product and dollar is the price. So students, that's what we have done here. If you can see, 1 rupee is equal to $0.02, that is 1 by 50. Everybody clear? $1 was equal to rupees 50 as the spot, right? So if I take an indirect reciprocal, do you realize it will be 1 rupee equal to dollar 1 by 50, that is 0.02. And now children, this is the price of the rupee which is expected to appreciate by 5%. So 0.02 plus 5%, if we do, it will go to 0.021. I have rounded off the figures, okay, 0.021. And then children, now that you have these rates, let's convert them back to the rupee per dollar rate. That means children, do you realize, of course, $1 equal to rupees 50 will continue as it is, and this children, $1 will be equal to 1 upon 0.021, that is 47.619 rupees. And on the basis of this, we will recalculate children. Can you see here that when rupee has appreciated, of course dollar has depreciated, right? And children, here 103 into 47.619, the new rate, minus 100 into 50, correct, plus 3 into 47.619, that is the new rate, the whole upon 100 into 50 into 100 will give you 0.9523%, correct. This is a return, right? The return you're getting is 0.9523%. Now if you check institute solution, they are not getting 0.9523, they're getting 0.7%. I'll tell you why they're getting it. So why their answer is different? Their answer is different because in their solution, if you study it carefully, they have assumed that if rupee appreciates by 5%, that means dollar depreciates by 5%. See, if rupee appreciates against dollar, dollar will depreciate against rupee. That is no debate right there. But the debate is, or basically there is no debate here also, the point is, the fact is that the percentage appreciation and depreciation against each other of both currencies won't be same. If rupee is appreciating by 5%, it is not necessary that dollar will depreciate by 5%. You do the mathematics. You must have been taught when you were taught forex, right? This is not the case. And children, this error ICAI has taken here, okay, same error ICAI has taken here. They have done this same error in one earlier question also, in a sense, which was there in the practice manual earlier. So I am not taking that error. I am going ahead with the actual data, right? With the actual data, the answer comes to 0.95. They are getting 0.7%. Of course, if you ask me what to do, if this question comes as it is, then kindly follow the institute. Everyone clear? Following the institute means, students, do you realize that here I will say, okay, $1 is rupees 50. If the rupee is going to appreciate by 5%, dollar will depreciate by 5%, that is 50 minus 5%, whatever this comes to. Take that number and solve this again, right? That is the suggestion I can max give, right? All right, then they're asking you, will your answer be different if this guy invests in the bond just before the interest is payable? Doesn't matter, children, if he pays the money just before interest is payable, the eventual answer won't change. No, our answer will not differ even if Mr. Mammon invests in bond just before the interest is payable. Okay, so with that we complete question number 9. Let us now move on to question number 10. Children, question number 10 now is from the chapter of International Financial Management. Some call it as Foreign Investment Appraisal. This is dependent on the concept of ADR, GDR. Okay, so I have a video explaining a similar kind of a question. Okay, I will pull out that video and share it with you. Please watch that video. Once you're done with that video, you will be very easily able to solve question number 10. Okay, please watch. Question number 10. On the concept of GDR, students, I request everyone to first of all pause the video and read the question carefully. Start. Okay, students, I hope you all read the question. Let us now try to understand this. Odessa Limited has proposed to expand its operations, for which it requires a fund of $15 million. Okay, so can I say an Indian company requires fund which is equivalent to $15 million. Okay, net of issue expenses which amount to 2% of the issue size. It proposed to raise the funds through GDR issue. It considers the following factors in pricing the issue. Expected domestic market price of the share is rupees 300. 3 shares underlie each GDR. Underlying shares are priced at 10% discount to the market price. Expected exchange rate is rupees 60 per dollar. You are required to compute the number of GDRs to be issued and the cost of GDR to Odessa if 20% dividend is expected to be paid with a growth rate of 20%. Children, as I was explaining to you this entire story, I told you one thing. Yes, I told you one thing regarding the fact that as the MPS in the local market fluctuates, of course the ADR and GDR's value also will be fluctuating in their local markets. One more thing you can of course therefore understand, that if this Indian company does anything in consideration to those shares, then of course the ADR and GDR will be affected, because those ADR and GDRs are nothing but derivative instruments whose underlying assets are those shares. Everybody following? Which means, children, do you also realize that if this Indian company issues dividends, then those dividends are entitled to be received, of course, by the ADR and GDR holders. I hope you understand. Yes. So now, children, in this particular question, okay, in this particular question, they are saying that the required fund, okay, required fund is given to you as 15 million, right? Required fund is given to you as $15 million. Everybody following? But then they say that the issue expenses are going to be 2%. Yes, 2%. They're saying net of issue expenses which amount to be 2% of the issue size. Which means, children, do you realize that if I issue shares worth 100, can I say I will be able to pocket only 98, because 2% is the issue expenses. Now they are saying that we want 15 million net of issue expenses, which means, can I say I want 15 million here? So what should be the actual issue size? Did you understand? Which means if I issue 15 million only, do you realize I will be pocketing 15 million minus 2%? That is not what I want. I want net of expenses 15 million, which means, can I say I will have to issue instruments worth 15 divided by 98 into 100, that is 15.306 million. Yes, 15.306
million worth instruments I'll have to issue. Everybody clear? Then they say that the expected domestic market price of the share is 300. One GDR instrument underlies 3 shares, which means in one instrument there are 3 shares underlying, and the underlying shares are priced at 10% discount to the market price, which means, do you realize that 1 GDR, okay, 1 GDR issue price, okay, issue price should be how much? It is 3 shares worth into, children, they are saying the current market price expected is 300, so I'll multiply by 300. And now they say that as far as the issue price is concerned, we want to have a 10% discount given to these global investors. Children, do you realize the whole minus 10%? Everybody following? So on the calci, 3 into 300 minus 10% comes to rupees 810. Therefore, rupees 810 should become what, children? It should become the issue price in Indian rupees. But children, can I say we are tapping the foreign market? Here, children, do you realize the foreign market means it is end of the day dollars only? Yes, it is supposed to be ADR, but they are giving it to you as GDR. Doesn't matter. For us, it is foreign, and let us raise the money and complete the question. Children, do you realize here they are saying that the exchange rate expected is rupees 60 per dollar. So can I say if $1 is equal to rupees 60, the 1 GDR issue price in dollars will be 810 divided by 60. Very simple, correct? On the calci, 810 divided by 60, if we do, we get $13.5. Yes, $13.5 is the issue price per GDR. Everybody following? Yes. So with that, students, do you realize we have got the issue price per GDR? Now we know that the total issue value has to be $15.306 million. We know 1 GDR is to be issued at $13.5. Can I say number of GDR to be issued? Okay, number of GDRs to be issued will be 15.306. Okay, I'll write down here 15.306 divided by 13.5. Yes, 15.306 divided by 13.5. On the calci, 15.306 divided by 13.5 will give us 1.13 million GDRs. Everybody following? 1.13 million GDRs are therefore to be issued. Is the story clear? Great. Now, children, moving on. Moving on means what, children? They are asking you what will be the cost. See, first part is done. Compute the number of GDRs to be issued is done. Now they are asking what is the cost of GDR to Odessa. Students, cost of GDR means cost of capital they are asking, and this is connected to the equity share. So the best is to use the KE formula, D1 upon net proceeds or P0. I hope you remember your childhood. Yes, plus G. Here, children, the D1. Now for D1, what we'll be doing is we'll be assuming that the face value is rupees 10. Okay, the face value is rupees 10. Children, 10 rupees per share if I take, do you realize per GDR the face value will be 3 into 10, that is rupees 30, correct? 3 into 10, that is rupees 30. And considering the fact that 20% dividend is paid, can I say my D1 will be 30 into 20%, that is 6. Now what is 6? I'll again repeat. Children, they're asking you the KE. KE means the cost of the GDR, and considering the fact that it is connected to equity only, we're going to use the Gordon's formula for calculating KE, that is D1 upon P0 or net proceeds plus G. Children, as far as D1 is concerned, tell me from 1 GDR certificate how much D1 you will get. Can I say we'll get the D1 which is equivalent to the D1 of 3 shares, because in 1 GDR there are 3 shares. Everybody following? The children, if D1 is for 3 shares, what is the D1 per share? Now per share they are saying that 20% is the dividend, 20% on the face value of the share, and the face value of the share is not given in the question, so I'm assuming it to be 10. Everybody following? So children, on 10, if 20% dividend is given, and for 3 shares, I hope you realize 6 rupees is the dividend per GDR. Everybody following? So children, do you realize I'll write down here 6 divided by now the net proceeds. Children, can I say net proceeds per GDR will be how much? Can I say the issue price per GDR is rupees 810 for the 3 shares. I hope you understand, and considering the discount also 810 rupees, but the 810 will not be entirely pocketed by you because there is a 2% expenditure. I hope you understand. Issue expenditure flotation cost given in the question. So can I say my net proceeds will be 810 minus 2% plus, children, the growth rate given is 20%. So children, can I say 810 minus 2% will be 793.8. So it is 6 upon 793.8 plus 20%. I'll just rewrite this here, 793.8 plus 20% on the calci. 6 divided by 793.8% plus 20 will give us 20.76% as the cost of GDR, cost of underlying equity in one sense. Everybody following? See, for this particular company, it is cost of equity only because the company is issuing equity shares, right? It is not issuing GDRs. But because it is issuing equity shares, which then gets converted to GDR and so on, they're asking you the cost of GDR to you. Everybody following? And in that, children, can I say we have taken into consideration the 10% discount also given, as well as the 2% issue expenditure. Everything is taken into consideration, and our cost therefore swells up to 20.76%. Everybody following? So with that, children, we complete this question number 10. I hope you all understood this question. I'll now flash the solution on the question on your screens. You can pause the video and copy down the notes. Thank you very, very much for the patient listening of this entire chapter of foreign investment appraisal, that is international financial management. And as I said, I'm giving you 2 more questions for self-practice with solutions. So I hope that you will be sincere enough and will actually solve those 2 questions. And also, children, as far as the theory part of this particular chapter is concerned, I have given it to you in the question answer format in your notes. That is the question bank. I hope you will go through it also. Very important. Yes. So thank you very much.
Okay, students, I hope you all watched it. I hope you understood it. So can we go ahead? It's a very similar kind of a question. 2 extra points that they have asked here in this RTP is, what is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? So if you see the solution, we have already understood how to calculate the cost of the GDR, correct? And the cost of GDR in this question is coming to 18.3. So children, if bank loan is available at 12%, then of course we should accept the offer. Why to go for GDR to raise the money? Let's go through the bank loan. And children, they are saying how much can the company save by choosing the option? Of course, children, do you realize it will be 18.3, okay, minus 12%, net saving of 6.3%. Very simple, 2 additional points asked in this RTP. Okay, so with that we complete the discussion to question number 10. Let us now move on to question number 11. Children, question 11, again I have recorded a video on the basis of this question. I will share that video with you. Please watch it. You'll be able to easily understand this question. Please start.
This particular question, we'll quickly go through it and understand how the cap is being applied here. They're saying a textile manufacturer has taken floating interest rate loan of rupees 40 lakh on 1st April 2012. So somebody has taken on 1st April 2012, yes, a floating interest rate loan of rupees 40 lakhs. The rate of interest at the inception of loan is 8.5% per annum. Interest to be paid every year on 31st March, and the duration of loan is 4 years. So children, do you realize if on 1st April 2012 he has taken a loan and annual interest is to be paid on 31st March, that is at the end of each year for the next 4 years, the 4 payments will be on, first is 31st March 2013, then 31st March 2014, 31st March 2015 and 31st March 2016. Yes, and of course the first payment will be on the basis of 8.5% per annum, and then the remaining payments of course will depend on the interest rates which will be relevant or applicable at the start period of the loan, which will be applicable for the entire loan period. In the month of October 2012, the Central Bank of the country releases following projections about the interest rates likely to prevail in the future. Point number 1. On 31st March 2013 at 8.75%, 31st March 2014 at 10%, 31st March 2015 at 10.5%, and on 31st March 2016 at 7.75%. Show how this borrowing can hedge the risk arising out of expected rise in the rate of interest when he wants to cap or peg his interest cost at 8.5% per annum. So children, if he wants at the maximum that he wants to pay in interest should be 8.5% per annum, irrespective of whatever the spot interest rates are. Can I say he has to buy a call option on interest rates at 8.5%, when the strike price is 8.5%? Everybody following? So he has to buy an interest rate cap at 8.5% strike rate on a total notional principal of rupees 40 lakhs. Everybody clear? So see what they are telling you. Point number 7, this is a solution of ICAI. As borrower does not want to pay more than 8.5% per annum on this loan, where the rate of interest is likely to rise beyond this, hence he has to hedge the risk by entering into an agreement to buy interest rate cap with the following parameters. I hope you remember, cap gives the holder or the buyer a right to pay interest at a fixed level. If the S1 crosses this K, then children, do you realize he will be in the money? Everybody following what I'm trying to say? So notional principal, this is national written by ICA, it is notional 40 lakh, strike rate 8.5. We will be comparing, this is K, I hope you understand. We'll be comparing with the S1, the rate of interest applicable in the spot market. Calculation and settlement date 31st March every year. Duration of the cap till 31st March 2016, and premium for caps negotiable between both parties. Okay, to purchase the caps, this borrower is required to pay the premium upfront at the time of buying caps. The payment of such premium will entitle him with right to receive the compensation from the seller of the cap as soon as the rate of interest on this loan rises above 8.5%. So which means they are saying that, you know what, if the interest rate in the spot market goes to, let's say, 9%, children, can I say the payment therefore will be in favor of the cap holder, because the S1 is now above K, it's in the money option. So 9% is the S1, K, children, is 8.5, S1 minus K, I hope you remember, S1 minus K will be the gross payoff, that is 0.5%, that is 9 minus 8.5% on 40 lakhs will be what the option seller, the cap seller, will have to pay to the cap buyer. And of course, children, I hope you remember that the person who is buying the cap, of course, will have to borrow in the spot market, yes, at 9%, but from the cap option he will be receiving 0.5%, and therefore his final net payoff will be 8.5% only, of course without taking the premium into consideration. Okay, the compensation will be at the rate of the difference between the rate of none of the cases. The cost of this loan will rise above 8.5, calculated on 40 lakhs. This is some grammatical mistake they are showing. I hope you understood the meaning of it. This implies that in none of the cases the cost of the loan will rise above 8.5%. This is what they wanted to say. Of course, right, the maximum he'll be paying is 8.5, because tomorrow, children, if the spot interest rate, let's say, goes to 7%, the option will be lapsed. 0 will be the value out of money option, and he will be able to borrow from the spot market, of course, at 7%, 7.5, whatever it is. Everybody following? So children, do you realize in that case his interest, of course, is less than 8.5. This is the whole concept of a call option, right? That the maximum he will be paying is the K. Everybody clear? This hedging benefit is received at the respective interest due dates at the cost of premium to be paid only once. Of course, the cost of premium had to be paid only once, that is today, that is when you are actually going for the cap option, that is the moment you have to pay the premium. Nothing much about this, right? So let's now go ahead. They're saying point number 2, assume that the premium negotiated by both parties is 0.75% to be paid on 1st October 2012, and the actual rate of interest on the respective due dates happen to be, as on 31st March 10.2%, 31st March 2014 is 11.5%, 31st March 2015 at 9.25, and 31st March 2016 at 9% and 8.25% they have given to it. It's again a printing mistake. Show how the settlement will be executed on the respective interest due dates, or the perspective interest due dates. Can we start? So children, do you realize that they are saying here, see, please pay attention, the premium to be paid on 1st October is 30,000. From where we got 30,000? They are saying, right, it is 0.75% premium. Yes, 0.75% premium. So 40 lakh, okay, into 0.75% will give you the premium to be paid. The payment of this premium will entitle the buyer of the cap to receive the compensation from the seller of the cap, where the buyer will not have any obligation. The compensation received by the buyer of caps will be as follows. Children, the compensation will be received only and only if the S1 on due date is more than the K. Everybody following? The S1 on due date is more than the K, then he will get compensation. If the S1 is less than K, the cap option will be out of money. The buyer will anyways be borrowing from the spot market outside. Okay, so let's see. So children, on 31st of March, okay, on 31st of March 2013, the spot interest rate is 10.2%. Okay, 10.2%. Children, do you realize that on 31st March 2013, the buyer of the cap will receive the compensation at the rate 1.70%? That is 10.2 minus 8.5. Everybody following? If he has a right to borrow at 8.5 and the spot price has gone to 10.2, he is of course in the money option now and will be receiving 10.2 minus 8.5, that is 1.70% to be calculated on 40 lakh, which comes to 68,000 compensation to be received. Everybody following? Moving on to 31st March 2014. Children, at that time it is 11.5. Again he will be compensated. 8.5 is the strike rate. 11.5, children, do you realize 3% additional compensation he will be receiving? And that's what they're saying here. Yes, 3% is the compensation on 40 lakh, which comes to 1,20,000, which he'll be receiving on 31st March 2014. On 31st March 2016, children, the strike price of course is 8.5% and the spot price is 9.25, so 0.75% is the compensation that he will be receiving on 40 lakhs. I hope you are able to understand. And children, on the last date, that is 31st March 2016, two rates they have given. One of them of course is wrong. ICAI has taken the rate of 8.25, which means this 9% is a printing mistake. Need not think about it. 8.25, children, do you realize will be less than the strike rate and therefore no compensation will be received. That's what they're saying. Yes, so the buyer of the caps will not receive any compensation as the actual rate of interest is less than 8.5%. Everybody following? And of course therefore his interest liability shall not exceed 8.5 because he will be borrowing at 8.25. Thus, by paying the premium upfront, buyer of the cap gets the compensation on the respective interest due dates without any obligation. So what they are saying is, once you pay the premium, then on each due date, children, do you realize he will be receiving the premium in case the interest rate in the spot market goes above 8.5? Because children, do you realize if it goes above 8.5, he will have to borrow from the spot market at that higher interest rate, but from the cap option he will be receiving the premium, thereby his net interest rate, children, do you realize will be 8.5 only. And in case the spot interest rate is below 8.5, he will not receive anything from the cap option, of course, because the option is out of money. But children, do you realize in the spot market he will be able to borrow at that lower spot interest rate. Therefore, by doing this, children, do you realize he is capping? Yes, he is ensuring that his maximum interest is paying is 8.5%. Everybody following? That was this one simple question, children, on this concept of interest rate caps. Thank you so much.
Okay students, I hope you all saw this video. I hope you understood how to solve this question. Let us go to the next. Children, question number 12 is from corporate valuation. This concept, children, is of economic value added. You must have been taught EVA, economic value added, the concept from the chapter corporate valuation. This is a very old question, okay, quite similar to what institute had earlier given also. I'll just share my video for the same on this. You can watch the video and then we'll go to the next question. Please watch. On the concept of economic value added, I request everyone to pause the video and read this question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand this. Herbal Gyan is a small but profitable producer of beauty cosmetics using the plant aloe vera. This is not a high-tech business, but Herbal's earnings have averaged around 12 lakhs after tax, which we will be taking as no PAT. Okay, that is EBIT post-tax, largely on the strength of its patented beauty cream for removing the pimples. We'll go ahead. This is ICAI question, not mine. The patent has 8 years to run and Herbal has been offered rupees 40 lakhs for patent rights. Herbal's assets include 20 lakhs of working capital and 80 lakhs of property, plant and equipment. The patent is not shown on Herbal's books. Suppose Herbal's cost of capital is 15%. What is the economic value added? Very simple question, students. Question number 30. Tell me, what is the formula of EVA? EVA formula, children, is EBIT post-tax minus total capital employed into WACC. Correct? Children, as far as EBIT post-tax is concerned, they have given it to you as 12 lakhs. See, there is no interest or debt mentioned in this question. So this 12 lakhs I will assume to be EBIT post-tax only because there is no interest in the question. So this 12 lakhs, children, children, I took it as NOPAT, that is EBIT post-tax. So straight away I'll write down here equal to 12 lakhs minus. Now children, as far as total capital employed is concerned, the assets are given. No problem. Total of assets will be taken as a total of total capital employed. Now as far as assets are concerned, can I say children 20 lakhs working capital, that is current assets, net current assets, plus 80 lakhs of fixed assets. So 20 plus 80 lakhs is 100 lakhs. And they're saying that the value of the patents, the intangible assets it is holding is 40 lakhs. And it is not shown in the books of accounts, which means, can I say, apart from this 20 and 80, another 40 children, can I say, should be added to the value of the capital employed. So 20 plus 80 plus 40. So I'll write down here 20 lakh plus 80 lakh plus 40 lakh. This will be my total capital employed now, multiplied by WACC given in the question straight away as 15%. So I'll write down here into 15%. So children, on the calci, 20 plus 80 plus 40 into 15% is 21 lakh. So 12 lakh minus 21 lakh will give us a negative EVA of 9 lakhs. Yes, so simple question this is. So with that children, we complete question number 30 also. I hope you all understood this question. I will now flash the solution of this question on screens. You can pause the video and copy down the notes. Thank you very much students. We go to the next video where we will be studying question number 31, another question on economic value added. Thank you so much. See, first of all, understand students, all these questions I am showing you all of EVA are not manufactured by me. These are all past exam questions or PM or RTPs of institutes material only. So please take them seriously. I am very sure you are finding EVA very simple now. That's it. You have to continue the same thing. Nothing much is there. Yes. So thank you very much. Okay students, I hope you all saw the video and you understood this calculation of EVA question. Let's go to the next. Children, the last practical problem is from the chapter of mergers and acquisitions. Okay, it's a similar question which was asked earlier, but 2-3 new points are there, so we will discuss this question. Okay, what are they saying? B Limited wants to acquire S Limited. So B is the acquiring, S is the target, and has offered a swap ratio of 2:3. 2:3 children, do you realize means for every 3 shares held by the target company, acquiring company will issue 2 of its shares. Okay, that is 2 shares for every 3 shares of target. Following information is available, lot of information is given. They are saying required, point number 1, the number of equity shares to be issued by the acquiring company for acquisition of the target company. Children, here if you can see that the target company number of equity shares, okay, number of equity shares of target company are 1,80,000. So students, if you are holding 3, you will get 2. If you are holding 1,80,000, then you will of course get 1,80,000 into 2 by 3. 1,80,000 into 2 by 3 will eventually come to 1,20,000. So the answer to the first point is that acquiring company will be issuing 1,20,000 shares to the shareholders of target company. I'll show you the institute solution. Okay, you can see here 1,20,000, point number 1. Point number 2, they are asking what is the EPS of B after the acquisition. So children, they are asking you after acquisition what will be the earnings per share of B Limited. Very simple answer, I'll give it to you children. Do you realize post merger earnings will be 21 lakh plus 4,50,000 assuming no synergy. So this is 25,50,000 post merger earnings divided by number of equity shares post merger, do you realize will be 6 lakhs plus 1,20,000 you issued in point number 1, that is 7,20,000. So if you take the calci, 25,50,000 divided by 7,20,000, 3.54 rupees will be the post merger EPS of the acquiring company. Let us check the solution here. Yes, they have got 3.54 as the answer to point number 2. Moving on children to point number 3. Determine the equivalent EPS of S Limited and calculate per share gain or loss to the shareholders of S Limited. Children, if you can see, S Limited were earlier having EPS of 2.5. So imagine a shareholder who is having 1 share, okay, who is having 1 share of this S Limited. Can I say he is getting EPS of rupees 2.5? Now, when he shifts to the new company, the acquiring company, he'll have to surrender this share and he will get shares in the acquiring company. Now for every 3 shares held, you're going to get 2 shares, right? Which means you will be getting 2/3 of a share. Everyone clear? So now in the acquiring company, the EPS is 3.54. Everybody clear? 3.54. But you won't be getting the entire share there. You will be getting 2/3 of the share. Everyone clear? It is not 3:3 ratio, right? It is 2:3. So children, you can also think like this: 2 divided by 3, you will get 0.67 of the share, right? If you're holding 1 share, you will get 0.67 of the acquiring company share. That is nothing but the ratio of 2:3. So for 1 share, if you're going to get only 0.67 shares, and that share of the acquiring company is going to give you a 3.54 rupees EPS, the equivalent EPS for you would be 3.54 into 2 by 3 or 3.54 into 0.67. 3.54 into 2 by 3, children, this comes to 2.36. okay, 2.36. The equivalent EPS is 2.36. Earlier they were getting 2.5 per share, so 2.36 minus 2.5, there is a loss of 0.14 to the shareholders of the target company. I'll just show the solution here. Can you see? 3.54 into 2 by 3, 2.36 minus the earlier EPS will give you a loss of 0.14, right? Moving on to point number 4. What is the expected market price per share of the acquiring company post merger, assuming its P ratio remains unchanged? So children, if the P ratio of 10 times of the acquiring company remains unchanged post merger also, do you realize the market price per share post merger will be 3.54, that is the EPS post merger multiplied by the P ratio. You also know, right? EPS into P will give MPS. 3.54 into 10, 35.4 will be the post merger market price. So you can see point number 4, 35.4, right? Moving on to point number 5. Determine the market value of the merged firm. Children, market value of the merged firm, okay, is nothing but total earnings multiplied by P ratio, right? Earnings per share into P ratio will give you market price per share. Total earnings into P ratio will give you total market value of the company. So 21 lakh plus 4 lakh 50,000, okay, multiplied by 10, obviously, children, that comes to 2 crore 55 lakhs. Okay, I'll show the solution here. They have got 2 crore 54 lakh 88,000. I'll tell you why. They have taken another route here, which includes some rounding off. Students, what they have done, they are saying that okay, 1 share, as we got some time back, was rupees 35.4, correct? 1 share was rupees 35.4 multiplied by 7,20,000 shares outstanding, and do like that also, market price per share multiplied by total number of equity shares. So 35.4 multiplied by 7,20,000, you will get 2 crore 54 lakh 88,000. Now children, that answer, okay, this answer here is slightly rounded off because this number is slightly rounded off. Everybody, you're able to understand what I'm trying to say, that EPS of 3.54 was rounded off, therefore MPS of 35.4 became rounded off, therefore the overall value got rounded off. But don't worry, this answer is of course perfectly legitimate, right? All right, so moving on, point number 6. After the announcement of merger, prices of the target company rose by 10% on BSE. Mr. X, an investor having 10,000 shares of S, is having another investment opportunity which yields annual return of 14%, is seeking your advice whether he needs to offload the shares in the market or accept the shares from B Limited. Children, what is Institute saying? Very simple. They are saying, okay, what was your share price earlier? 17.5, right? It is expected to rise by 10%. So 17.5 plus 10%, which means you will be having shares of 19.25 rupees, right? Now, you also know that the equivalent earnings that you will be getting in the new company will be 3.54 into 2 by 3. That is 2.36, correct? 2.36 will be the equivalent earnings in the new company. So 2.36 is the earnings, 19.25 is the value of your investment. Do you realize if you calculate the returns, 2.36 divided by 19.25 into 100, this comes to 12.25% effective yield you are getting if you stay in S Limited and eventually go to the acquiring company. But on the other hand, if you remove your money, if you sell off your shares, and then children you go for that another investment which you have, which is giving you 14% return, then of course I would recommend you to kindly do that, because your return there would be higher. That's what institute is saying. Children, can you see? They are saying return on market price is 12.26, correct? 12.25, 2597. So this is rounded off to 2.6 here. Okay, so 12.26% is what you will get as the yield. If outside you are able to earn 14%, it is advisable to offload your shares. Everybody clear? So with that, students, we complete the discussion to the last question, the last practical problem of RTP for May 2022 CA final, strategic financial management. There are 2 theory questions also given, which of course you can read on your own. I hope this entire video of 13 questions was relevant, important and useful to all of you. From here at J. Krishna Classes, we wish you all the best for your CA final exams. Thank you. Take care. Goodbye.